For close to an hour and 45 minutes. So it's a long session. And these are the primarily 5 topics that we plan to cover. So we are going to start with subledger accounting. So before we get into the actual receipt accounting, you need to understand what is accounting, right? First, and then we'll learn what is receipt accounting and then cost accounting. So to set the context and also set the foundation, I'll spend some time on explaining what is accounting and how is it done. Then we'll get into the actual topic of receipt accounting. Okay. Then we'll see what is accrual and receipt with an example, with a demo, and see how you can do accrual clearing. And finally, just a couple of slides on accrual at period end. So majority of the portion we'll be spending on points 2, 3, and 4. But before that, I want to give you a quick understanding of subledger accounting engine. So let's get started with that. So what is subledger accounting engine and why do you need it? So subledger accounting engine, again, if you are from EBS background and if you are from release 12 of EBS background, then you know what is subledger accounting engine, and the same engine is uptaken into the cloud with minor modifications, which I'll specify that as we go along. But it's exactly the same engine from the architecture standpoint, from the functionality standpoint, fine with very minor tweaks. For those of you not from EBS, so it's kind of an accountant. Okay, the engine is kind of a replacement for an accountant who typically looks at the transactions and does the accounting, right? If a chartered accountant is sitting and he will be looking at all the transactions that are taking place in an organization, and he would be taking note of the accounting, some account being credited, some account being debited, and he'll be making those entries in a physical book. Typically, that's how it used to work previously when there were no computers. But now, the same job is done by subledger accounting engine, SLA. So the subledger accounting engine looks at all the transactions and does the accounting for those transactions. That's what it does. So if you look at the products that we have in the cloud, so you have subledgers on the left hand side, and there is GL here, and the engine sits between the subledgers and GL. So subledger is the place where transactions are created, right? What are subledgers? Subledgers are payables, receivables, assets, cost accounting, receipt accounting. So these are all subledgers. Inventory transactions. These are all subledgers, and all of these subledgers create transactions. So I've listed some of them, but they're a big list. All of them will create transactions. These transactions have to be accounted. What could be these transactions? So these transactions could be pure receipt, delivery, sales order issue, movement of the goods from one inventory to another inventory. So these are all typical transactions that can take place in the supply chain. So all these transactions have to be accounted. They also have to be costed. That's a different topic altogether. So there are 2 primary topics here. One is accounting topic and the other is costing topic. So we'll focus on the accounting today. So when you create transactions in supply chain, they have to be accounted. So the engine looks at all these transactions. So whenever you create a transaction, the transaction will log events into the events table in subledger accounting engine. And you have rules and sources in the engine. Those rules will look at those events and transactions, and they create the output. And the output in this case is accrual credit and expense debit. It's a simple pure receipt. So the journals that get created, they are still called as subledger journals. They are not in GL yet, as you see. They're not in GL. They are within engine. So these subledger journals have to be transferred to GL and imported into the GL. So transfer will place them in interface table, and import will pick from interface table and places them in GL journals table. Okay. Now that you have journals, you have to post them. And when you post them, the GL balances get updated, and we have a multi-dimensional cube in GL that gets refreshed with the new balances. This all happens in the background. So all of these processes can be scheduled. So you can schedule an accounting job. You can schedule a transfer job and import job, and you can schedule the posting job. So you probably schedule them once an hour or once in 2 hours, whatever, depending on your need, or end of the day. So you schedule them, and all of that happens in the backend. So you just create the transactions, and rest of the stuff can be automated. So you create transactions, they are picked up by the engine. Engine creates the subledger journals. Subledger journals are transferred to the GL, imported and posted. Now the key point here is that there is a trace that is maintained right from the transaction to the balance level. So the system keeps track of how the transaction is being converted, generated as a journal, and journals are generated as GL journals, and GL journals are ending up as a balance. So the system keeps trace of it. So when you click on some balance here, you can in fact drill down to the journal. From journal, you can drill down to the subledger journal, and from subledger journal, you can drill down to the transaction. So the drilling down from the journal to the actual transaction is possible because you maintain the trace of how the transaction is resulting in a journals. So that's an extremely powerful functionality, right? So to be able to look at a journal and navigate to what transactions are contributing to that particular balance, right? Okay, so this is all part of our core financials, these two products, right? And it serves for all the subledgers, not just for supply chain. This is the same for projects. It's the same for assets. Any of the products that you can think of. All the transactions that are created are all accounted by one single central engine, which we call as subledger accounting engine. Okay. Now there are two important pieces in this engine, as you can see, is rules and sources. So sources are nothing but view objects, and they expose the transaction data. So the engine does not know anything about the transaction. So the transaction data has to be exposed through sources. And rules are written rules guide the engine on how the transactions have to be accounted, right? So if you are following IFRS standard, the rules are different. If you are following a US GAAP standard, the rules are different. So the rules will define how a particular transaction is accounted in the system, right? And you can modify rules if you want. If you're not happy with the seeded rules, you can go ahead and modify them. But the sources cannot be modified. Sources are all there seeded out of the box. You cannot modify them, or you cannot create new ones. But the rules can always be modified. Okay. Now, just to give you a little more details on the engine. This is the output. So I'm going to talk about the rules now. So rules portion. So I said rules and sources. I'm going to focus on rules. This is a kind of an output that you see. I'm showing you for project costing, but any journal would look something like this, right? So you have some lines debited, some lines credited, and it would have certain account and some description, and of course the amount and currency, etc. All of that. But that's the output. This output is contributed by several rules. So this portion of the output is contributed by journal line rule. This is contributed by account rule, and this is contributed by description rule. All these three are put together called as journal entry rule set, and all the rule sets are put together into method. And that's the method that you assign to your ledger. So that's the key thing. So every ledger has an accounting method associated with it, and the method has rule sets, and rule set has rules. That's the hierarchy. Okay, ledger, accounting method, journal entry rule sets, and rules. Something like this. So ledger, method, rule set, and journal line rule, account rule, and description rule. So that's how they are architected. And this is how they are architected in EBS. This is cloud. So EBS versus cloud, you see not much of difference. Only thing is it's flattened by one level. So we used to have it. We have in fact a 4 levels in eBusiness Suite. Now it's just 3-level hierarchy. It's kind of these two are combined together. And the key thing that you need to understand from supply chain standpoint is this. In EBS, you define in EBS basically you define several accounts, right? As an inventory org on the inventory org page, inventory org parameters go there and you define several accounts, accrual account, or the expense accrual, actual accrual account, inventory account. So these are the accounts that you define on the inventory org page. Now we don't have that page at all. So any account that you think of have to be defined within account rules. So you have to go and populate your code combinations in the account rules. There is no other UI that you would see, right? So there is no, the only place where you go and populate all the accounts is the account rules page. That's where you go and define all your accounts, okay, accrual accounts. So whatever accounts that you can think of that you used to define at inventory org level, you go and define them in account rules. Okay, that's the place where you capture the accounts. And please go through this PDF document that explains how you go and populate those account rules. How do you navigate to those screens and populate the account code combinations? Okay, so that's a very quick high-level picture of what Subledger Accounting Engine is. It's primarily a financials topic, but it's important for you to understand what is the engine before we actually get into the receipt accounting or cost accounting later. Okay. So I see no questions. I'm moving forward. So let's get into the receipt accounting and let's talk about overview first, and then we'll get into more details. So I'm sure all of you know, when you receive the goods, you accrue them. You do an accrual accounting, right? So you book an accrual. So there are two types, two options that you have in accrual accounting. One is accrue on receipt and accrue at period end. Most of you may be knowing it. Accrue on receipt and accrue at period end. So inventory items. For inventory items, there is no option. So all inventory items will be accrued on receipt. All inventory items will be accrued on receipt. For expense items, you have an option. Expense items can be accrued on receipt or they can be accrued at period end. So you have two options for expense item, but for inventory item, there is only one option, which is accrue on receipt. And we'll see what it is, and then we'll see what is accrued period end. So let's look at accrue on receipt. Okay, let's see. So in a typical P2P cycle, right? So these are the main events that would happen in a typical P2P cycle. What are they? So you create a requisition, and requisition can be converted into a purchase order, and supplier sends you the goods. So you're going to receive them, you're going to inspect them, and you finally deliver them to the inventory. Put away is deliver, and then you will get an invoice from supplier. So you're going to pay that. So requisition, purchase order, receipt, inspect, put away, invoice, and payment. So that's the typical process, right? So what exactly happens in the back end at these events? So how does the engine accounts these events? Number one is requisition. At the time of requisitioning, if you had enabled encumbrance accounting, then there is an encumbrance that gets booked at the time of requisitioning. And the type of that encumbrance, we call it as commitment. So C stands for commitment. So you're basically committing to pay something, because you're raising a requisition, meaning you're requesting for goods, so you are ready to pay something against it. Okay. Now, when requisition is converted to a purchase order, the encumbrance will be changed from commitment to obligation, because you are now obligated to pay. So purchase order is a legal document, right? So now you have some obligation there. If the supplier provides you with the goods, you are obligated to pay him. So the encumbrance that was there as commitment will be knocked off, will be reversed, and it will be converted as obligation. So a new obligation is created. Now you received the goods. When you receive the goods, accrual account will be credited and receiving account will be debited. Okay, and encumbrance will be totally relieved. So you knock off the encumbrance because you are booking the accrual. So when you're booking the accrual, you don't have to maintain the encumbrance. It's hitting the actual account here. So the entire encumbrance is knocked off, so relieved, and accrual is booked. Now when you inspect it, the goods are moving from receiving to inspection. So receiving is knocked off and inspection is booked, right? And after you inspect them, and assuming that you are going to accept them and you deliver it to inventory, then inspection account is knocked off and inventory account is booked. So you are hitting the inventory finally. So you're sending the goods to the inventory, so the inventory account gets debited. Now you will later get an invoice. So when you have an invoice, the accrual that you booked at the time of receipt will be knocked off and liability is booked. So you are not liable to pay because there is a legal document for you to pay. So the accrual is knocked off and liability is booked. And finally, when you make the payment, liability is knocked off and the cash is credited. Okay, so these are the typical accounting entries for accrual and receipt. If you look at all the entries in summary, you find that net accounting for this all the transactions is nothing but inventory debited and cash credited. Rest of all get knocked off. You see accrual credit here, but accrual is being debited here. Receiving is debited here, receiving is credited here. So these two knocked off. Inspection is knocked off here. Inventory is the only debit that remains, and the cash is the only credit that remains. That's what you would expect, right? You will basically spending cash and getting something into inventory. That's the net result of the accounting entry. Okay, so this is how the cloud would account the accrual receipt. Now, there are several products, several sub-components that will take care of different aspects of the accounting. So you see these two portions here, the receipt accounting and the inspection accounting that you're seeing is done by a product called receipt accounting. That's the name of the product. And the inventory portion is done by cost accounting. So in the cloud, we have two different products called receipt accounting and cost accounting. In other words, we separated the receipt accounting portion from the cost accounting portion. In e-business suite, they both are together. In the cloud, we separated them. Why? Because there are customers who don't want to use costing at all. So they are just using the inventory. They don't have manufacturing. They don't have anything, just the inventory. Then they can go and set up just the receipt accounting and start using it. So the receipt accounting is not dependent on cost accounting in the cloud. So you can separately or exclusively set up a receipt accounting without having to do a cost accounting setup or costing setup. Okay. So we have two products basically, receipt accounting and the cost accounting, and both of them together are part of cost management product. So cost management is a broader term, and within cost management, we have receipt accounting, cost accounting, and of course, there are several other products like costing. Core costing is also part of cost management. So I'm talking about only accounting portion here. So receipt accounting, cost accounting put together is called cost management. Not put together in sense, additionally with some more functionality, it is called as a cost management. Okay, now let's move on and see how about accrued period end. So what I explained was accrual at on receipt. So for expense items, as I said, you can choose to accrue them at period end. So here the events are requisition, purchase order, receipt, and period end, next period. So that's what would happen in case of period end. So let's see what are the accounting. So the same case with the requisitioning and purchase order, same kind of encumbrance, but at the time of receipt, there is no accounting at all. So that's why we say accrued period end, not on receipt. So at the time of receipt, there is no accounting, but at the time of period end, So you book accrual and it will get immediately reversed by next period. So, and the period end, you do the accruals, do the period reporting, and then reverse them in the next period. And when you get the invoice, that's when the encumbrance is relieved and liability is booked, and you make the payment. So that's the key difference between accrued receipt and accrued period end. Okay. And there is no cost accounting here because we are not talking about inventory at all. So you see only receipt accounting taking care of all the account. There's no inventory. So whenever there is a transaction that is hitting an inventory, only then you see the cost accounting coming into picture. So there is an inventory account being impacted. So that's why cost accounting takes care of it. If there is no inventory at all in your example, like here, cost accounting does not come into picture at all. So it's all done by receipt accounting itself. Okay, so these are some of the key capabilities. We're going to see them anyway, so I'm going to move on. And again, I'm saying we're focusing on receipt accounting portion in this session. So next session is going to be about cost accounting. So we'll focus on receipt accounting first. Now so the receipt accounting has an integration with all other products. It has to have this integration because it gets impacted by the payables, it gets impacted by the purchasing, receiving, as we've seen. We'll see how landed costs can impact it, and projects, SLA, cost accounting. So it kind of integrates and interacts with all these products. Now let's take an example. Let's get into a little bit more details on accrual and receipt. Okay. So before I go there, let me take a few questions if I have any here. Can we update, delete, or add manually any journal in the SLA? Okay, can we update, delete, or add any manual journal in the SLA? Okay, so you can update, you cannot delete, or you cannot add. So you can update a subledger journal, for example, by overriding the account. So you see the account and you find it's not the correct account. I may want to override it. So we have an override functionality in subledger accounting that's also recently introduced. But other than that, you cannot do anything. At what level inventory account is stored? Inventory organization or sub-inventory? So it's up to you. So you can define it at sub-inventory level or you can define it at inventory level. So there's a white paper that I have shown you, right? So just take a look at it, how to define the account. And the answer is you can define it at either of the places. Receipt at period end is part of comms management or not? Receipt at period end is part of comms management. I'm not really sure what it is. Cost management, okay. Receipt at period end is part of cost management or not? No. So receipt at period end is the job of receipt accounting. Okay, and which is again the part of cost management. So if you, let me show you this slide. So when you say cost management is the broader product term. So cost management has lots of subcomponents: receipt accounting, cost accounting, costing, profit cost analysis. These are all several components within cost management. All of them are put together or called as cost management. So receipt accounting is responsible for all non-inventory related transaction like you are seeing here. All inventory related ones are done by cost accounting. So in case of period end, there is no inventory here because it's expense item. So that's why you see that they're all done by the receipt accounting itself. Is landed cost management a different module in the cloud? Yes. So we are going to talk about it tomorrow. There used to be custom sources in EBS. Is it not available in the cloud? So custom sources are not available in the cloud in SLA. In case of accrual at period end, what if invoice came before the period end? How does it consider the accrual? So there's no difference whatsoever. So if the invoice comes before period end, Accrual is the liability is booked and there is no accrual at the period end. So the accrual at the period end, these entries would happen only for uninvoiced receipts. If the invoices are, if the receipt is already invoiced, then they are not picked up for this accounting at all. So the program has picked this accounting because the invoice was not received. So if the invoice is already received, then you don't see these entries at all because liability is already booked. So you don't have to accrue anything because you are already liable to pay. So there is no point in accrual. So if the invoice comes before the period end, those will not be picked for accounting because the anyway liability will get booked. Okay. What's the benefit of doing at period end? So there's no such benefit as such because these are more important terms. Inventory items are all important to track and trace it as soon as you receive it. So you want to book the cost as soon as possible. Expense items are not so not so critical to identify the cost because expense do not generally flow into any inventory. So you can leisurely do it at the end of the period. But inventory is something that you want to track at that moment. So expense, you can wait till period end, no issues. Is the accrual reconciliation process similar to release 12? Yes, it is similar, and I'll talk about it. Does the receipt accounting cover all kinds of receipt, including IMT, consigned, etc.? Yes, you're right. It does cover all kinds of receipts. Where can we create landed cost factors in the cloud? So just hold back on that question. Tomorrow is the session on landed cost. Receipt at period end is part of cost management or not? Yes, it is part of cost management, as I answered previously. Okay, so let's move on and take that example that I was talking about, a little bit drilling down on that concept of accrual and receipt. So we are coming back to the topic accrual and receipt, but this time we'll go in detail. So as I was mentioning, we have two important and different products within cost management called as receipt accounting product and cost accounting product. And they have some interface tables and they have some distribution tables. And we have a product called Subledger Accounting Engine that I talked about, which does the accounting. Right? Subledger Accounting Engine takes care of accounting. And we do have another product called Transaction Account Builder, TAB. Transaction Account Builder. So the role of Transaction Account Builder is to default accounts on the transactions. Like if you're creating a purchase order, you want some accounts to be defaulted onto it. Expense account, accrual account, so inventory account, etc. So these are the accounts that you want them to be defaulted onto the purchase order. So previously you used to write account generator workflows in EBS. In EBS, you write the account generator workflows and they default the accounts onto the purchase order. So in the cloud, there are no account generator workflows. It's all done by Transaction Account Builder, TAB. And to learn more about Transaction Account Builder, please attend our procurement workshop. So it's kind of primarily focused on procurement because when you create a purchase order, you want the accounts to be auto-populated. And TAB does that. Okay. So I'm creating a purchase order here and my accounts got defaulted from TAB, Transaction Account Builder, and I receive the goods, right? I receive the goods against this purchase order. Now, after that, there are several processes that you need to run to account it. Before you actually run the accounting engine, you need to run several processes. Okay. And these processes that I'm going to talk about can be scheduled. You don't have to manually run them every time. You'll schedule them and they keep doing their job in the backend. So you don't have to worry about it at all. So those programs you need to know as an implementation consultant. You need to know what are those processes that are running in the backend. So that's transfer transactions from receiving to costing. That's one process. What does it do? The receiving transaction, right? The transaction that you have just created, that will be picked up and it is sent to costing, meaning it is going to be populated into interface table. The receipt transaction is populated into the interface table. There is another process, create receipt accounting distributions, that picks up that record in interface table and puts it across into distributions table. And then you finally do the accounting, meaning running the engine. When you run the engine picks up the distributions and creates the journal entries. Okay, so there are three basically processes that you run in the sequence, and this is what is the accounting entry that you would see: accrual credited and inspection debited. That's what we were talking in previously as well, right? Okay, now receiving is done. Now I'm so that I don't have any inspection here, just to simplify the use case. So I'm directly putting them away into the inventory. So when you do a deliver transaction, then what you run after the deliver transaction, what you need to run is transfer transactions from inventory to costing. Previously it is receiving to costing, now it's inventory to costing. And then you do create cost accounting distributions. Previously it is receipt accounting distributions, now it is cost accounting distributions. So that's going to again pick the transaction from interface to the distributions, and then you do the cost accounting, create accounting. So SLA will pick the records from distributions and create an incident. So basically the delivery event will result in this accounting. Receiving event will result in this accounting, right? But in the backend, this is what is happening. Okay. And finally, you get an invoice. When you get an invoice, you do the create accounting directly, and then this is what is the output. As I explained these entries previously, right? And then the key thing here for you to understand is that this is happening in receipt accounting, this is happening in cost accounting, and this is probably happening. This is in fact happening in payables. Three different places the journals are getting created, subledger journals. Now you see that the important thing that you want to track is whether the accrual is getting knocked off correctly or not. So you want to reconcile the accrual accounting always. So the accrual that you booked in receipt accounting, is it getting knocked off correctly or not? So I have booked for 5,000, so I need to make sure 5,000 is knocked off there. So that is the reconciliation process that you do before the period end. We call it as accrual reconciliation. So you want to make sure accrual you are booking at the time of receipt is getting knocked off at the time of invoice, and there is no difference there. Okay. So to ensure or to enable you to do the reconciliation, what you do is you want to be able to bring this accrual and map it with this and see that there is no difference. How do we do it? So you run a process called transfer cost to cost management. So that's going to bring this accrual line into the receipt accounting and do the matching. So this is what is going to happen. So these two processes you run, and thereafter you click on match receipt accruals. When you do the match receipt accruals, it is going to match this line with this line. And then you see and when you do the matching, it does the matching. And when you run the report, it's going to pick 5,000 credit from here and 5,000 debit from here and show you both the debit and credit in the report output. And you should ideally see it as 0. Whatever is credited should be debited unless you didn't receive the invoice yet. If you have received the invoices, all the invoices, then the accrual should be 0. Right? Debit and credit. So that's how you do the reconciliation. We'll see that with an example. Right? So in this example, by the way, I have created a purchase order with 50 quantity and price is 100. So 100 multiplied by 50 is 5,000. So 5,000 is the PO amount here. Okay. Now, let's take an example. Okay, before that, okay, let me take an example. The example that we have just seen is all, in this case, it's all good because I booked 5,000 and I got 5,000. So knocked off zero. I'm fine. There's no problem. But there are cases where the accrual that you booked and the accrual that is going to come in from the payables do not match. And there could be various reasons for it. And some of the reasons I tried to list them here. It could be because of the discrepancies in supplier billing. It could be because your account payables clerk matched to wrong invoice, matched the invoice to the wrong purchase order, or the quantities are different on receipt and invoice, etc., etc. So let's take one such example and repeat the same use case. So here again, I'm not going to go in detail because we've seen all of this. Now again, I have taken a 50 quantity and 100 price. So it's again a 5,000 invoice, sorry, 5,000 purchase order. So I have 5,000 booked here and I delivered them. So 5,000 gone into inventory. But when I get the invoice, I got the invoice only for 49, right? So I got the invoice only for 49. So the invoice accounting will be booked against 4,900. So I got the invoice for one lesser amount, one lesser quantity. So it's 4,900. So if I repeat the steps and I run the reconciliation program, I find that okay, I saw a beep, so I was looking at. That's an exception, so I don't find. I see only one person complaining, so I'm going to move forward. So when you do the accrual reconciliation report, it's going to pick this line and this line, and you see that there is a difference. There's a difference of, sorry, there's a difference of 5,000 and 4,900, so the difference of 100. Why is there a difference? So you will analyze why there is a difference, and you find that, okay, so I got the invoice only for 49. So now it's up to you whether you want to wait until the supplier sends that additional invoice for that one quantity, or you may want to knock it off. So you may think that, okay, the supplier is never going to send it. So that's why supplier sometimes sends the little difference in the quantity. So I really don't want to wait. So these supplier errors are normal. So I don't want to have this residual amount lying in the accrual and showing incorrectly. So I go and clear it off. So that's accrual clearing. So you can knock off. You can write them off, saying, yeah, so I just knocked it off. So that accrual clearing can be done in two ways. You can do it manually, or you can create rules and execute the rules automatically. Okay. Now, after you clear it, what exactly is going to happen? So now, in this example, I went and cleared that 100. I will show you how to do that, but just focus on the concept, then we'll see how to execute it. So I'm going to go and clear that 100. As I said, I can do it manually or through the rules. We'll see the example with the rules. So I cleared it. So when you clear that, there will be additional entries that get generated. And those additional entries, nothing but the accrual will be reduced by 100, right? And the same inventory would also be reduced by 100. Why are you reducing the inventory also? Because you want to track the cost appropriately, right? So you did not pay 5,000 to the supplier. You paid only 4,900 to the supplier. So inventory did not cost you 5,000. Inventory costed you only 4,900. So that additional reversal entries that you see would flow into inventory as well. So the inventory is evaluated correctly. So inventory is valued correctly, right? So the reversal of 100 would be captured here as well as it is flown into inventory as well. So now when you do the reconciliation, now these two lines are picked and this line is also picked. So if you see net, it's going to be 4,900 here and 4,900 here, and you don't see any balance in the accrual reconciliation report. Okay. So this we'll see by creating a purchase order and taking you through these steps, but we will be focusing only on this portion, not on this portion. This is cost accounting that you are going to learn. For you to understand this, you need to have some basic understanding of cost books, costing methods, and all of that. So which Dharam is going to explain after the break. So we are not going to focus on this. So we'll focus on this portion on how to do the reconciliation, etc. Okay. Now let me take a couple of questions. In release 12, create accounting cost management used to take care of accounting entries. So we have created accounting receiving. In cloud, do we need to run both these programs? Yes. It's two different programs in the cloud. Can you touch upon the variances too, PPV and IPV? Yeah, so if there are variances, so for example, if the price of the item, here it's basically the quantity that we have shown differently, but if the price of the item has changed, that will not okay, let me put it the other way. So if there is a change in the price, so whether it is because of the price increase or decrease in the IPV, basically the IPV is created, but you don't see any difference in the accrual. So the IPVs do not result in any accrual reconciliation issues. Let's take an example. So let's assume that it is 50 here, but the price has changed. Price is like 110 now. So then it would be what? 5100. Invoice would be 5100. But in that case, accrual is going to be 5000. Okay. IPV is going to be 100 and liability is going to be 5000, 5100. Okay. So the accrual will still be booked for the same amount, but you will have additional line called IPV. That IPV will flow into inventory because you have to capture the inventory at the actual cost. So the IPV would also flow into inventory if you're using, of course, actual or average costing. So any difference in the price will be fed back to the inventory. Okay, because you want to track the actual cost of the item. So the actual cost of the item has increased now because you have got an increase in the price of the item in the invoice. So that additional price that you got on the invoice will be fed back to the inventory, and the item will be costed more in the costing engine. Okay, so the IPV basically does not result in any accrual reconciliation issues. It will just add to the cost of the item. The accrual reconciliation issues you would find only when the quantities are different or when you are matching to some other purchase order, some mistakes that you do in the system. Okay. Is it automatic, the flow of IPV to inventory? Yes, it is. It is automatic. How about LCM accounting? Please don't ask any questions on LCM yet. We have a separate session tomorrow, so let me just pull this up. So there's a landed cost management. So just wait for your questions until then. And by the way, before I forget, so tomorrow we are going to do supply chain financial orchestration and landed cost. Okay, so these two are the topics for tomorrow, and Friday we'll do that, and these two will be done. So Dharam will remind you at the end of the day as well. Okay. Oh, sorry. So how about PPV and IPV? So I just answered that. So PPV and IPV would not result in any accrual reconciliation issues. The PPV or IPV, both of them will flow into inventory. Are the match receipt accruals and accrual reconciliation reports separate processes in cost management? Yes, they are separate, and we'll do that right in the demo. I'll show you how to do that. So I will take you through the end-to-end process in the demo. All of that we have seen, I'll take you through in a second. But before that, I want to make sure you understood the concept. In case of ASBN, the invoice is created before the item is received, so the accrual is debited before it is credited. Yes. Or clear account balance. Okay, the same question again. Accrual reversal, is it new in the cloud? No, we had it before as well. So, but you can do it using the rules now. That's new. So otherwise you have to do it manually. Is the accrual reversal automatic? No. So as I explained, So the accrual reversal, you would, I wouldn't say reversal, basically, accrual write-off in this case. So you would do it only when you are sure that you are not going to get any additional info. It's your choice whether you want to do it or not. Okay. If, say, for example, you, for this supplier, for a specific supplier, you see this discrepancy always to the extent of 5%. Right? So you say that, okay, for this supplier, 5%, there is always a error variance. So for this supplier, let me write a rule. Let me write a rule saying, if this is supplier, this is the item, this is the discrepancy, go ahead and write it off. So you can write a dynamic rule to automatically write it off, or you can do it manually. So if you are not, if you are very concerned about losing some particular, incorrectly tracking the accrual, then you would rather go for manual reversals. Where are the slides? Let me see. I don't remember. I am sure I uploaded some time back, so they should be there in the presentations folder. So let it come up. I'll show you. What will be the accounting entries for IPV? So I cannot really get into the all different use cases and show you the accounting entries. So you can just do a blind search in the Google for IPV and you get the entries. It's very, very straightforward. But as I said, with an example, for IPV, the accrual is going to be the same, right? But you will get additional line of IPV here and liability. Like 3 lines will be there: accrual, IPV, and liability. Okay. In case of transfer pricing between inventory organizations through transfer orders, is the margin going to be updated in the average cost of the item in the receiving organization? Excellent question. Answer is yes. And I'll show you tomorrow how it is done. So what are the accounting entries for IPV? I'm not going to explain that because it just takes another 10 minutes. So as I said, please go and search on my Oracle support saying IPV entries. There's a lot of material online on how the IPV is done. It's same as how it is done in EBS. So it's very standard functionality and a lot of content around accounting entries. But I want to focus on what I wanted to show in the cloud. But essentially, again, I repeat, it's going to be 3 lines here: accrual, IPV, and liability. Hopefully this is here. Supply chain managerial accounting presentations. Let me see if we can. Yeah, here they are. Okay, so you should look at supply chain managerial accounting. That's a separate folder. Can we have different accrual accounts based on supplier? Yes, you can. Okay. Both IPV and PPV distributions are generated by cost accounting. Is that correct? So the IPV and PPV lines are generated by respective products. Like for example, IPV is generated by payables, PPV is generated by purchasing, but they will be accounted by the cost accounting and receipt accounting programs. The lines are generated by the respective products. All right, let's move on and do the demo. This is one we'll try to attempt. Not this one. We'll attempt the one there we have a difference. So I'm gonna exactly these steps that I'm going to follow. So I'm going to create a purchase order, receive it, deliver it, and invoice it, and then we'll see the various steps by running the programs. So we have not scheduled any of these jobs. We have not scheduled these processes in this demo environment, and that was intentional because we want you to see the processes. So had we scheduled them in the backend, you would never know what's happening. So we did not schedule them. We will run them manually one after another and show you. But for customer demos, you will not be doing it. You will be scheduling them and the accounting would show up automatically. So in the entire steps that you've seen, whatever steps that I have explained, there are only 4 steps that you would be doing manually. which are creating purchase order, receiving the goods, delivering them, and probably creating an invoice. Those are the 4 steps that you would do. Rest of all the processing is done in the backend. But in this demo, I'm going to show you all these steps manually. Okay. So for the rest, not only today for this session, but next 3 days, you need a bit of patience because when you run these programs, they do not complete immediately. Most of them at least complete in less than a minute. But there are processes like create cost accounting distributions. It's a huge process. So it has to do a lot of things in the backend, like calculating the cost as well. So those are the processes that will take, say, 4 to 5 minutes. And we will use the time to answer the questions. But request your patience basically. Okay. So let's create a purchase order. So I'm going to go and log in as guy who has purchase procurement access. And I'm going to create a purchase order. I have a purchase order existing in the system, so I'll just make a copy of it rather than creating from scratch. I have taken down the number of the purchase orders. Oh, sorry. 162811. This was the long closed old one, so I'm going to make a copy of it, duplicate, and let's take down the new purchase order number as soon as it's done. Okay, 162877. That's our purchase order, and you see that I have quantity 50, price is 100, so net it's 5,000. Okay, so that's my PO. So I'm going to submit it, and I said it's auto approved. So I have defined the rules in such a way that the PO is auto approved, so I don't have to really approve it. So in a minute or so, I should get a notification saying your PO is approved. These are all older notifications. So I'm waiting for a new one to pop up. Hopefully that's done in a few seconds. Not yet. Okay. Come on. Yeah. Okay, so it's done. So the PO is approved. Let me show you that notification. The 162877 is done. Now let me go ahead and what's the next step? Is to receive the item. So let's go and receive this PO. Okay, receipts 162877. And let's do a receipt against this PO. And then the organization I had on the purchase order is 001. That's the org into which we are receiving the goods. I can actually see the expected shipments by changing it to, okay, I need to explicitly query it. So rather I would go and receive the expected shipments. And I have the purchase order anyway, query it and create a receipt against it. Okay, I need to change this as well. Okay, so that's the purchase order, 50 quantity and 100 was the price, so 5,000. So let's receive all the 50. So we'll receive the full quantity and put them across into the stores. So I'm doing a direct receipt. I am not really doing inspection, etc. I'm doing a receipt as well as to directly deliver to the goods to the inventory in one shot. So create a receipt. So it's a direct delivery mechanism. And yeah, so that's it. So I'm going to go and click on submit. So we received the goods basically and sent them across to the inventory. So we basically did both the shops, this and this. But as I said, we'll be focusing on the receiving accounting and not really on the delivery accounting or the cost accounting. You're going to see later. So we'll focus on receiving accounting and invoicing and see how the reconciliation is done. Okay, so the receiving is done. Now what should I do? My next step is to run this program, right? Transfer transactions from receiving to costing. So let's go and go to the other user. Let me take this off just to get some space and run the job. And the name of the process is transfer transactions from receiving to costing. So I have created a receipt. I'm sending the receipt information into the costing because these are all different products, right? So the receiving is a different product. Receipt accounting is a different product. So essentially sharing that information through the interface tables. So transfer transactions from receiving to costing. And again, as I said, I'm doing it manually here, but in the production, you will not be doing manual. You will schedule these and all of that is taken care in the back. So no parameters, just a simple process. So that's going to pick up my receipt and populate what? It's going to populate the interface table. And then I will need to run the second process that's going to pick the interface records and populate the distributions. Okay. So this should be done in few seconds. Okay. So I need to run the second process, which is the create receipt accounting distributions. So that process is not available as part of the submission page. So you will have to navigate to receipt accounting page. So this is the first time we are navigating into something that's costing related. So click on costing and you would find receipt accounting, cost accounting, landed cost in another product. Cost and profit planning is another product. Costing is another product. So these are all put together. We call it as cost management, right? So let's get to that. As you see, these two are different UIs, different pages. You have to do it receiving here and the inventory costing here. So let's go to the receipt accounting. And what I need to do create receipt accounting distributions. Create receipt accounting distributions. And I know the BU, US1 business unit. That's the BU where I have my purchase order. All right. Create done. So let me query that process. So it will take a minute or so to complete. Once it's done, we should be able to see the distributions here. So we'll do. So once this is done, we are going to run the create accounting and we should be able to see this accounting. So let's do that. Okay, I'm looking at the questions meanwhile while this is going on. I can't have the same instance open twice with the two different users in the same browser. Is it expected? Yeah, so you cannot have two different logins in the same browser because the browser session shares the cookies. So the moment you try to do it, it says you are already logged in. So the existing user is already there. So you have to have two different browser sessions for two different users. But in one browser session, you can have multiple pages like I'm opening here. Why is receipt accounting distribution not part of the first program like requested? Yes, of course, you can create all, you can bundle all of these. So you can bundle all of these into a request set and schedule them. So it's just not there in this environment. We didn't care to create it because we anyway wanted to show you manually. Could we not include the receipt accounting distribution in the main program? Yes, you can. So just this environment doesn't have. So okay, it's done. So let's go ahead and run the create accounting program. And create accounting I need to run for receipt accounting product. And I know it's US primary ledger. Let's see. So accounting all reporting style. Let's have a detailed report. And let's also include some transaction numbers in the output. Okay, we are good. So submit. Okay, so what did we do so far? So we are here. So we did this, this, and this. Now what should be the output? So the SLA must have created output. So we should be able to see this receiving inspection to accrual. So let's wait for the accounting program to complete. Let us query this program where it is. So it's still doing it. So once it is complete, I would like to show you the journals. And then we'll move on to the next step of invoicing. Meanwhile, again, looking at the questions. Okay, another question is, can you let us know if I can have multiple RMA lines created for a single sales order at different times? I would, my initial response, Krishna, is going to be yes, but I'm not 100% sure. I need to really check that with my order management guy, or I need to really verify that if that's the case by creating a sample sales order and returning, having a return capture. So yeah, please, I would suggest, Krishna, if you can post that question in the forum, and when you're posting it, just choose the right forum. Maybe you post it in the order management forum, and we can follow it up and answer for you. My initial answer would be yes, but I would love to verify that in the system before I can confirm that. A general question: is there a reason why it is so many steps to get accounting processed? So the reason why there are different processes is because all these products are modular products, right? The reason why we went to modular is that we don't want to have a dependencies between these products. Somebody who wants to implement only inventory and only the receipt accounting without cost accounting should be able to do it. So we don't want the customers who want only receipt accounting to be burdened with cost accounting setups, for example. So we have chosen to go with modular fashion, and customers will implement only the portion that they want. The negative side of this approach is that when the products are modular, so they don't share the same tables, so they maintain their own interfaces. So somebody has to move the data across these products, and these processes exactly do that. And we want it to be you don't see that basically, as you yourself pointed out in the question, if you schedule them. But the real reasoning behind these many programs is because of the modular approach. Can you touch upon some SLA rules? So I'm very sorry, I cannot get into in detail about SLA. If you are the one who are really interested in what is sub-ledger accounting engine, get into details on how to configure it, change the rules, play around with it, then please come to our financials workshop. And I do a 2-hour session there. So with an example, so that will be the right session. So this will be the wrong session to talk about SLA in detail because most of you guys will not be interested in it. Is a IMT an equivalent of IRISO of e-business suite? Yes, but it's not there yet. So IMT is supposed to be an equivalent of IRISO, but as I said, we don't have IRISO functionality yet. So in the future release, very shortly, you would have a provision to create IR, and IR would in turn create IMT. So it will not be creating ISO. IR would be creating an IMT. IMT meaning transfer order. So IR will be creating a transfer order instead of a sales order. So we have a transfer order foundation now. So we'll build upon it an IR integration that's going to come in future. But IRSO will be implemented as IRTO in the cloud. Do we schedule these processes to run on a regular basis or we schedule them to run monthly? So monthly may be a bit a longer duration. Maybe I would recommend you to schedule them overnight, a nightly basis, or probably once in 3 days, depending on the volume of the transactions, or maybe on the weekends. Yeah, so definitely want to do it more frequently than monthly. So because of the number of transactions that get accumulated, if you're doing it in one bulk. In case tax is enabled, is it part of landed cost? Will it wait for landed cost session? But just want to hear from you. So if the tax is enabled, it has nothing to do with the landed cost. So okay, so let me back off on that statement. So it depends on where the tax is being captured. So if it is part of the purchase order itself, okay, so yeah, let me state it as yes, it is handled by landed cost. So any additional expenses, including tax and any other expenses that you are going to pay, have to be captured as part of landed cost. So we'll see an example of that in the landed cost session. How do we create a request set in the cloud? So I will probably, what I will do, I will post a link on this page. So you go to references. If you go to references, I'll post a link there. So we have a note that explains the steps on how to go about creating a request set. Very straightforward. So let me populate a link here. I have those links already ready made. So I'll just copy paste them here and take a look at it. Okay, so let's move on. So we were, I just lost where we were. Okay, so we were doing the accounting. Okay, accounting is done. So I want to show you the output. So I'll go to receipt accounting, and here I want to query the distributions and show you what was the accounting review receipt accounting distributions. And I'll go by my purchase order. So I have the purchase order here. All right, search. So what was the accounting done for this purchase order? So I would ask you to ignore the first line. So the first line is coming because of the encumbrance, and we didn't enable encumbrance anyway. So the net accounting for that is nothing. So just ignore the first line. And the second line is what we are going to focus on, receipt into receiving. And you see the distributions that got created is accrual credit and receiving inspection debit. And you can see the journals as well. You see the code combinations and journals. So receiving inspection is debited, accrual is credited. So is that not what we were looking at? Right? This is what we expected, and that's there. Okay, so let's move on. So I'm going to skip this portion because that's cost accounting, which you are going to learn after the break. So let's skip that because you need to learn a couple of concepts before you understand what is cost accounting. So let's skip that and move on to here. So I'm going to create an invoice, right? Let me create an invoice, do the matching, and let the invoice be only for 49. Okay, so where do I create an invoice? So I need to go to payables. Payables and invoices. I'm going to match it to a PO. Let's create the invoice. And let's assume we got the invoice only for 49, not for 50. And we don't expect supplier to send the rest one invoice for the rest one. Okay, that's the PO. So creating an invoice based on the PO. You can give an Midtown Computer Services is the name of the supplier, and let's see what's the date. 22nd March and 1. Yeah, so it's for 4,900 only. That's what we are trying to create an invoice for, and I'm going to match it to the pure lines. So that's for that's the 100 price, and the quantity would be 50, right? But I'm going to make it as 49. I'm going to have an invoice only for 49. So supplier has sent me invoice only for 49 quantity, and we don't expect him to send any further invoices. So I'm going to just say save this. Validate it, and account it. Post it. Account and post. So we are here. Sorry, we are here. So we created invoice, created the accounting. So that's what's going on now. So once we are done, so these lines have come. Now I need to send this information back into receipt accounting so that it can do the matching, right? So I need to send it back so it can do the matching. So to send the information back, I need to run this program called transfer cost to cost management. Okay. So I'll wait until this job is done. So I'll wait until the accounting program is done, and then I will do the transfer cost to cost management. Okay. So let's do a transfer cost to cost management. This is going to pick up the accrual lines from payables and send them across to the distributions table in receipt accounting so that you can do the reconciliation, right? Transfer cost to cost management. So let's make sure it is done here, right? Yeah, it is done. Okay. So US 1 business unit, and let's do a cutoff date of tomorrow and submit. Okay, this should be done very quickly, and then we should move on to the receipt accounting and do the reconciliation. Okay, still going on. Seems to be a lot of transactions that it has picked up. Okay, so let's look at the questions. If the one quantity which we are talking about got rejected during inspection, would there be a different entry, or would that follow the same process that you are sharing here? So if the transaction is rejected, if the quantity 1 is rejected, it would never go into inventory at all, right? So the inspection stage itself, it's going to go back. So only 49 will be going into inventory, in which case the accrual receipt, accrual reconciliation report would match, because there is 4,900 there. Invoice is also coming from 4,900. So I'm taking a case of where you didn't receive 50, you did receive 50, but you rejected 1, right? So only 4,900 will go into inventory, and you also got an invoice for 4,900. So it all matches up. There is no reversal or the additional stuff that you need to do. Another question, in case of the FOB is shipment, the ownership is transferred to the buyer as soon as the goods are shipped and ASBN is received and the invoice is created. How is the in-transit inventory accounted as this balance sheet item? Okay, so again, Krishna, please hold back to that question. We'll deal with it to some extent in the landed cost. So please post it back when we are discussing tomorrow. There is a gap there, so I'll explain what is possible. Then you can figure out, or we can figure out basically what is the missing piece. Okay, it's done. So let's go on to the receipt accounting. So I'm in the receipt accounting, so I need to run the create a receipt accounting distributions, because that accrual is lying in the interface table that has come from payables is lying in interface table. So let's do a create receipt accounting distributions, and then finally we should be ready to do the reconciliation. Sorry, let me query the program. Okay, so another question meanwhile is in the list of the scheduled processes that you are showing, we do not see the previous processes run. Yeah, so that's expected. So you will be able to see the previous processes of only yours, right? It's by user. If you have submitted, I am switching between two different users in the browsers, so that you're not able to see the previous process because it's by user that you can see. So keep the questions coming in while this guy gets started. Okay, done. All right. So now I want to do the reconciliation. So we are here. We are done. We are done. We are done. So we are match receipt account. Let's do the matching. And then get the output. Let's do the matching from yesterday to tomorrow. Make sure today is fully captured and submit it. This is a quick one. Then we'll run the reconciliation report. Come on. Okay. So let's run the reconciliation report. It's there in the monitor process. So I'm going to go here and accrual reconciliation report. I can see it right here. Okay. Now let's do it only for our item. I don't want to reconcile all the accounts in the system, so I'll focus on my item and probably today's date. So all the transactions that we did are on this day. So I limit the reconciliation to only this day and also to my item. Okay. US1 business unit. Transaction date. So let's do between yesterday and tomorrow. And item is CM. I know the item that we used in the purchase order, so I'm going to go with CM200. CM200. Okay, that's it. Submit. Okay, let's see the output of this reconciliation report. Hopefully, it should be showing us 5,000 from receipt accounting, 4,900 from payables, and the difference of 100 should show up. Let's see. Okay, another question, since these jobs are time consuming, how can we expedite it to overcome performance issues in production? So don't basically go by what you're seeing in this demo. These are all the demo environments and these are no way close to production capacity in terms of the storage, network, bandwidth, compute. So these are all tuned to perform with for very high data volumes. So cost accounting and costing deal with huge data volumes. So the programs are perfectly tuned to handle high volumes, but these are all the demo environments of the code line that we are talking about is about 7 month old, and it's a very nominal server capacity, etc. So you don't have to worry about the performance. Okay. Let's see the output. Okay, so that's the output of the accrual reconciliation detailed report, and I'm looking at only for my item, and you see that accounts payable accrual balance is 4,900, and the PO accrual, meaning on the receiving side, it's 5,000. On the AP side, it is 4,900. So there is a net balance of 100. Okay. So now you look at this report and see, okay, so why is it not matching? So you see that receiving end you have 5,000, which is fine, and at the payable side, why is it 4,900? So you keep looking and you find that, okay, so I need to go and look in this particular invoice number. So this is the invoice number. So I go to this invoice and let me see what was the problem, and you find it. Okay, got the invoice only for 49. So then it's up to you to make the decision. Do you want to wait for that invoice? You know the supplier is going to send me the invoice for another item, or you think that, okay, this supplier, I have an error margin of 5% or 2% or 1%, so let me go ahead and write it off. Or you can write a rule to write it off. Okay, and or you may think that, okay, I don't want to write it, I'll wait for another 2 months probably. If I don't get it still, maybe I will write it off then. So it's all up to you. So let's now do what I would like to do is to now knock it off. So I know I'm not going to get this the 100 invoice. So let's go and do what clear it off. So let me take you there. So there are two ways to do it, manually or by writing a rule. So if you want to do it manually, you can go to adjust receipt accrual balance and knock it off manually, or you can write a rule. So I have written a simple rule. I'll show you the rule. So that's the rule I have written for this BU. And this is again written in OBR, Oracle Business Rules Framework. I said if the percentage under invoiced. So in my case, I'm under invoiced, and the percentage under invoiced is less than 5, and go if the percentage under invoiced is less than 5, then go ahead and clear it off. It's a very simple rule here that I have written, but you can in fact have a complex rule with and, or, etc., etc. And the fields that are available for you to write the conditions are as follows. These are the attributes that you have that you can base your conditions on. So percentage over invoiced, percentage under invoiced, over invoiced quantity, receipt age, invoice age, for example, or receipt age, for example. So you may want to wait for 2 months before you knock it off. So you can incorporate that into the condition, so on and so forth. And I leave you with a good reference page on how to write the rules. Beautifully explained with some examples right here. Okay, so you write the rules and you can execute them. So you can go and say, like for example here, I go and say clear receipt accrual balances. So this is going to execute my rules. Submit it. Okay. Let's wait for it to complete. Once it is done, we should be able to see that adjustment entry that we talked about in the example. that adjustment receiving entry that we talked about is this one, right? Additional 100 here coming in. So that we can see right here. So let's query the receipt accounting distribution. So we should be able to see that adjustment coming in. I'm requerying what we created previously. So we had two lines previously. Now you have another line called accrual clearing, and you see the distributions for it. You see that for 100. So ignore the taxes. We don't have any. I am not enabled taxes here, so it's coming as 0. Just ignore that in this demo environment. So you see it as accrual 100 debited and receiving inspection 100 credited. So an adjustment entry to knock off that 100 is created, right? Now, let me just account these lines, and then I should be able to. If I run the reconciliation report again, I shouldn't see any balance, ideally. So let us do that. So let me account these lines that got introduced now, the adjustment lines. Let's have a detailed report and have that capture the transactions. Okay, once we are done, we should be able to rerun the report and see that the balance is no more there. Okay, so that will take another 2 minutes. Okay. Okay, I'm looking at the questions, by the way. Is there no load reconciliation like in EBS? No, we don't have it. At what level the accrual rules work? Is it for inventory organization? Can we have it at supplier level? So the rule definition is at the BU level. So the rules are defined in a BU. But at what level they work within a BU is defined by what rules you have written, right? So if in your conditions, if you said if supplier equal to this and quantity under invoiced equal to 50, only then knock off. So you can make the rules applicable to a particular supplier, applicable to a particular item, applicable for against these attributes. So it's all up to you to choose at what level for what transaction the rules should get executed, right? So you incorporate that logic as part of the if condition. But the rule definition is at the BU level. So you will define rules in a BU. And the rules can have any of these parameters. So you can make it a supplier specific, item specific, category specific, and so on and so forth. Okay, it's still going on. Yeah, anyways, we don't have to wait for execution reports. So the process is done. So let's go and do the matching. Once the matching is done, we'll do the reconciliation report. Okay, it's done. So let's accrual reconciliation report. So hopefully that adjustment of 100 should be picked up, and we should see no balance in the accrual. That's our business unit. Come on. Transaction date. Just limit it to today. And CM8 to 1, 2, 3. I think that was the item. All right. Okay. So this again, this environment, sometimes the submit just gets disabled. So I'm gonna have to close it, open again, and go and do it again. So I'm going to go to the scheduler page. Submit accrual reconciliation report. Submit is enabled. Okay, good. Um, Giving the dates. I'll limit myself to this item. Submit. Okay, I'll look at the questions meanwhile. In case pay on receipt is enabled and we have thousands of transactions, is there a different rule applied to write off the accruals? There's no different rule. You have to write based on your requirements. So, and as I said, these rules can be based on those payload that I have shown in the slide, right? So there are no other write-off rules. So these are the only rules that we have. Okay, the same report I'm running now, and you see the net accrual is 0. Why? Because you see that PO accrual is also now 4,900 because of the adjustment that has come in, the last line, accrual clearing line that has come in. So now it's all good. So there's no balance. So this is a very simple case that I was showing, but it's not as simple as this. The reconciliation process needs efforts on your side. It's a few days of effort. So you have to go through each one of them and see why there is a difference in the accrual. So you will go back to the invoice and see what was the problem. So it's an activity that you do before the period is closed. But just to show you the concept, I chose an easier case just so that we can do it in a given time that we have. Okay, so we are done with this. Again, couple of points on the offset days, so you can go through that. So we saw that demo. And one of you were asking about IPV, right? Couple of you. So I have a slide for IPV as well. So I will try to upload that, including this slide. Maybe I'll take you through in a couple of minutes because at least 3 or 4 of you have asked. So the same case, now I chose to change the price. Now, when you change the price, this is the accounting that you would see. So the accrual is going to be still 5,000, but there will be IPV of 50 and liability is going to be 49.50, right? Because there's a change in 1 rupee or $1, whatever. So this does not impact your accrual reconciliation because the accrual is still the same. So 5,000 and 5,000, but IPV is different. So what exactly happens is that this IPV that you are seeing of 50 will be flown back into the inventory as you're seeing here, right? So the additional 50 adjustment entries will go into the inventory. Why? Because I paid only 49.50 to the supplier. My inventory cannot be 5,000 because I paid only 49.50. So the inventory has to be reduced by 50. So the IPV or any discrepancies that you have or gate loss, any kind of discrepancies between the exchange rates or prices will be fed back into the inventory like you see. All of this is done automatically. You don't have to worry about it. Only thing that you need to make sure is you are using actual costing, actual or average costing. If you're using a standard costing, Obviously, these differences will not flow into inventory because your inventory is always valued at standard cost. So what is standard, what is average? Again, you'll learn right after the break. So that's why I don't want to get into these. But yeah, so if you're interested, that's the slide. Just one slide on the accrued period end. Very, very straightforward. So as we discussed previously, so at the time of PO receipt, there is no accounting. When the invoice is booked, that's when the encumbrance is knocked off and you book the liability here, right? And you have a few reports. You have a report, not few reports, just one report. And one program to create uninvoiced receipt accrual. So this will create all the accruals at the end of the period for all uninvoiced receipts, and you do the accounting. And we do have a short video that explains how to close the period, close the receipt accounting period. Okay, and in the very next period, you will see the reversals getting created. So you accrue the uninvoiced receipts, and they get reversed in the next accrual period. So in the next period. Okay. All right. So that's all I intended to cover, and let me take a look at the questions. In case of internal transfers with transfer pricing, can we have different transfer prices based on different items within the same organization? Answer is yes, but it's not very straightforward. It kind of a workaround currently, which I will explain while I'm doing the supply chain financial orchestration tomorrow. But that's area that is getting improved in release 13. Release 13 is very straightforward. Basically, you can define transfer prices on based on different parameters, including items. Yeah, so that's all I can say. But we'll discuss more about it tomorrow. Can you please point us to the exercises in the activity guide to practice these steps? These steps I don't think are there in the activity guide. This is something that I have come up with to make you understand the concept, but you can. So lessons 3 and 4. So you go to activity guide and look at lessons 3 and 4. Those are the activities. Okay, I see no more questions, so I'm going to call for a break. Sundaram, if you're online, please come back and announce the break, maybe for 10 or 15 minutes, whatever you feel like.
58% of you are looking at my screen, now 55. If you're able to hear me and having a cup of coffee or looking at your emails, please get back to the WebEx screen so that we can go ahead and get started. As you mentioned that I'm going to go over costing or cost accounting foundations. As everybody, I believe you guys have background about cost management. It could be from EBs, and majority of I think from EBs because we hear lots of EBs questions. Cost accounting, once you set up, you are done. You would eventually run ESS jobs, and you should be able to look at your cost, the level at which you have set it up in terms of how you want to track and look at the cost of your quantities or the inventory. So for next 2 hours or so, I am going to go over majority of the time over the setups, how you can do setups and what are the key capabilities and benefits of costing within the Fusion application. We try to get some of the concept from EBs and we enhance it in Fusion application. So you will see some of the additional benefits which we give you out of Fusion application. So let's look at the supply chain managerial accounting applications. When I say managerial accounting, as Srini mentioned that it has receipt accounting, cost accounting, landed cost management, and cost and profit planning. So we'll look at all of these and the significance of those modules and what they offer you out of box. And I'll talk a little bit about the implementation options, how you can pick and choose which model you want to go and implement. And I'll show you some of those work areas. Already Srini talked about receipt accounting work areas. Likewise, I'll talk about cost accounting and then various other work areas which are available. And then quickly go over setup of cost management. So from the solutions footprint standpoint, what we have done in Fusion application is from the subscription standpoint, you have receipt accounting and a cost accounting. So if you are a procure to pay customer and your customer is not managing the inventory item, only expense item is done, you need not to subscribe for cost accounting. You can simply subscribe receipt accounting, and receipt accounting would eventually help you to manage your accruals, the way Srini talked about, and you'll be able to manage your expense accounting. If your customer is using inventory items, you may need cost accounting and receipt accounting both. So cost accounting solution would help you to manage inventory and manufacturing transaction costing and accounting. So if you are manufacturing, if you have inventory transactions, you need cost accounting and a receipt accounting. Cost and profit planning, we call it as cost planning. You would be able to estimate the standard cost of your item. So for example, you may need a visibility into, or you may want to take certain decisions. It could be pricing decisions, what if analysis, or sourcing decision, whether to make it or buy it. So cost and profit planning would help you to estimate the standard cost. And you can simply subscribe cost and profit planning if you are using it only for planning purposes. And if you want to use the standard cost into your enterprise or in your organization, you need receipt accounting, cost accounting, and cost and profit planning. Unlanded cost management, Srini will come back and talk about how we can model the entities in terms of additional cost while absorbing or purchasing your products or goods. So from the cost management standpoint, these are the solutions which we offer. From the implementation standpoint, I already talked about briefly. You can only implement cost and profit planning if you need a solution for business decisions like what if analysis, pricing decisions, make or buy decisions, and product lifecycle cost projections, predominantly for non-accounting purposes. And if you have that requirement, you go implement only cost and profit planning. And if you need a solution for accounting of inventory and manufacturing flows, you need receipt accounting and a cost accounting. And at the end, if you need standard costing method in your enterprise, you need all of this. This is the implementation options, and you can take a look at it and subscribe and start using it. This is the work area. We will go over this work area, typical cost accounting work area, where you as a cost accountant, you would be able to review the item cost. You would be able to create the distributions. You will be able to review the distributions and create accounting and so on. As I mentioned, that once the setups are done, you would run many ESS jobs, and your activities are done. So you run the jobs and you'll be able to look at the information. I'll quickly go over application. Whenever I go over application, I'll show you those work areas and then take you over various other work areas. Srini already talked about receipt accounting work area, so I'm not going to go over. This is the cost and profit planning work area where you will be able to manage the standard cost of the purchased item. You would be able to manage the cost of your resources and could be overheads. And you can use the scenario to roll up those costs so that you will estimate the standard cost for assembly, for that matter. Or you may want to publish those standard costs to cost accounting so that whenever you use the standard cost method for certain items and you get those transactions within your inventory, you can use the standard cost, whatever cost you have estimated and published into cost accounting. So you use this UI to estimate it, and tomorrow or day after tomorrow, I'll talk about how you can integrate this cost and profit planning along with your manufacturing. Landed cost, where you can define your trade operations and you can use landed cost management to acquire products and the additional overhead on those purchases. From the key capabilities standpoint, you can define the cost at a granular level. It could be at the sub-inventory level, locator level, lot level, or serial level, grade level. Our idea was wherever you can track the quantity, we should be able to calculate the cost and store. So you have a flexibility to manage the cost at a granular level. You could have various grades. Like, summer is coming up in India, so you'll have mangoes, and mangoes will have various grades, and then you could have grades or cost of mangoes by grades. You could have by lot, locator, serial. You could have it by sub-inventory, or for that matter, you could have cost by inventory organizations, and you have flexibility to share that cost with various other inventory organizations within your business unit. So pretty much flexible. When we design this, we design in such a way that wherever you can keep track of the quantity, we should be able to calculate the cost and store. And to be in sync, whenever we calculate the cost, and cost could be your actual cost or average cost. So what we do is we calculate the cost, and along with that, we store the quantity of those inventories, so that your inventory quantity and cost will be in sync always. You have flexibility to track the cost and the profit in inventory. So tomorrow, Srini will talk about it. You could have various trade operations, and in supply chain financial orchestration, you have flexibility to route your goods. You could have physical flows and you could have financial flows, and if the financial flow is different than the physical flow, you could have internal profits, and you can go book the internal profits using cost accounting solution. You have a flexibility to do transactions, inventory transaction into multiple UOMs, like you have got primary UOM and the secondary UOM. And costing solution also helps you to manage the cost in primary UOM or the secondary UOM. So you go look at it by what UOM you want to track the quantities and cost, and we do it for you. You could share the item cost across organizations. So there is a concept called valuation structure. And there are various inventory attributes you would specify, and then valuation structure would eventually help you to manage the cost and share the cost. So you can define at what level you want to share. It could be at the cost organization level. I'll talk about cost organization in some time. It could be at the inventory organization level. It could be at the sub-inventories and so on. So you could identify how you want to share your cost within the organizations. And you have flexibility to estimate the standard cost using cost and profit planning. One of the other benefit of cost accounting is you could have multiple representation of the same cost. Meaning, let's say you are in Europe and you have corporate currency called euro, and you could have a local currency, and you may need a reporting requirement that corporate reporting requirement would be in euro, and then local reporting requirement would be in local currency. So using cost accounting solution, you have flexibility to report the cost and quantities using multiple representations. It could be your currency could be different. For certain reporting requirement, your maybe cost method could be different. For corporate reporting, you may be using actual cost, and for internal consumptions, you may be using average cost, and so on and so forth. So you have flexibility to have the multiple reporting requirement fulfilled by multiple representation of your cost, and that could be through different currencies or different valuation methods. Valuation method is, I'll talk about it, valuation method in some time. Or for that matter, cost method could be different. So keep this in mind that we offer you multiple representation of the same cost, and it could be in terms of currency, it could be in terms of the costing method, and you can use it for internal reporting purposes if you choose to. Another capabilities, and some of these capabilities you might have already seen, is the set ID. It is a PeopleSoft concept which we leveraged, and where we can share the setups across organizations. If you need the consistent accounting policies. You have flexibility to define certain configurations and use them across all your organizations. In our case, like, in Fusion application, what we have done is we have introduced a concept called cost organization, which will help you to account and cost the inventory transactions which are coming out of various inventory organization within your enterprise. So you may have a consistent policy that all the inventory organization may be using certain sets of configurations. So what you do is whenever you configure those, you configure it using set ID, and then set ID will eventually help you to share those costs across all your organizations. You have got OBR rules, which Srini has talked about in reset accounting. We have got OBR rule where you can clear the accrual balances automatically. We have got very good period close management, meaning you could configure period close exceptions. You have flexibility to specify whether or not you should allow the period to be closed, or you want to process those unprocessed transactions first and then close the period. So it's user defined. You can configure and then stop the period from closing, and so on. You can do that. That's the period close management. And we have got various dashboards which you have introduced in various other products as well. You see the dashboard. And same is the case with cost management. You have a dashboard where you can see errors and exceptions. You can take action on those errors and exceptions. From the integration standpoint, cost management is integrated with various other products. When I say products, are nothing but the subledger applications. So you could have various transactions. Let's take an example of sales order. In advanced fulfillment flows, we have seen that we created multiple sales orders, and eventually we ship those sales orders. And whenever you ship, there is some accounting happens, like you would have your deferred COGS and inventory valuation. So deferred COGS will be debited, inventory valuation will be credited, right? So we need those transactions, or we need those events within the cost management application. So you have got receiving transactions, you have got shipping transactions, you have got inventory transactions. For example, you issue out material to your work order. We need those transactions into cost accounting so that we can go cost those transactions. So all your receiving, shipping, inventory transactions from manufacturing are interfaced to costing through inventory costing interface. So I got inventory to costing interface. And some of the usage jobs Srini has already talked about, which was in context of receipt accounting. I will talk about it in context of cost accounting. So keep this in mind that we needed various transactions into cost accounting, and there are interfaces, and one of the interface which we talked about. We take all your resource transactions. Like, you are into manufacturing, you use your resources, we need those resource transactions, we need those operation completions transactions, and so on. So all of these resource transactions would come from manufacturing interface. You get the payable invoice the way Srini got those payable invoices into receipt accounting. You need payable invoices, and that will be transferred to cost accounting through interface with payables. So payable will be integrated with costing. We need revenue. Like, you ship the sales order, you raise the invoice, customer invoice, and you got the invoice. You got probably the revenue. You recognize revenue and receivable. We need that revenue to calculate the gross profit margin. So we have interface between receivables to costing, so that we get the revenue lines. And as soon as we get the revenue line, we can go calculate what's my gross profit margin. That will be your revenue minus COGS will be your profit margin percentage. And what we do is we also have interface with the feeder system. In this case, it would be your distributed order, orchestration, or order management. And all of these transactions will be picked up by cost processor, and cost processor would account them based on the cost method and the other cost policies. And subsequently, it will be transferred to subledger applications, and the SLA would in turn generate the journal entries and transfer it to GL, and it will eventually be posted to the GL. So this interface would pick the eligible transactions and do all of these costing using the cost policies. And at the end, there are certain outbound. One of the outbound interface is the projects. We do not have project manufacturing in release. Maybe current release and then next release and next release, because it's again depend on the install base which you are talking about. There is definitely roadmap, but it's not burning as of today. So for example, you are pegging the services to a project, and what you do is you receive those services and you in turn transfer those to project. And there could be another interface between costing to project would be your miscellaneous transactions to a project, and that would eventually send to the project accounting. So that's the interface which we have available here. All right, that's summary. Let me see if there are any questions which I can answer for now. How are the interface engine going to work? Like costing engine has to schedule to cost the transactions frequently, and answer to that question is yes, and it depends on how frequently you are getting the transactions. So you would have your interface, and then you would have your distribution, and distribution is nothing but your cost processor, and you would eventually schedule them. So as I mentioned that once the setups are done, based on the volume of your data, you go schedule those ESS job, and then based on those processes, you would eventually get your transactions costed. What's the significance of different costing method if you do costing at the granular level? Example, if it is FIFO, and that's the only FIFO we support. We don't support LIFO, and again, it's based on install base, and we talk to various customers, and then they use that LIFO. And some of the countries, FIFO, and some of the countries LIFO is not legal, so we do not have LIFO. We have only FIFO, that is actual. Sub-inventory, how it is work with other sub-inventory. So Prakash, I would request you to hold back to your question till the time I talk about valuation structure. So what we do is if you're trying to if your valuation structure is at the sub-inventory level, that means your item could have different costs within different sub-inventories. So you're sharing the cost within that sub-inventories, and if you have different sub-inventories, you could have different rates. That's something which says that it is valuation structure is at the sub-inventory level. Is it true we can control the costing method at item level? An answer to that question is yes, Kevin, you could do that. There could be a scenario in your organization, and there could be different sets of items for that matter. Some of the item categories, some of the item with certain categories you buy and resell. And in that case, you may want it as actual cost method, like whatever is buying, you're selling it off. That is actual FIFO. Some of the item you will be manufacturing in-house. So in that case, you would have your standard cost, which is appropriate, right? So you could do that, and I will show you how you can do it. And that's something which is new, which was not available into EBs. So we can have org at average and then item at the standard. So you could have you define the cost method at the item level. That's fine. You can define it, or you can have the default at organization level or at organization and category level. So if it is default, you would eventually default based on the attribute. Whenever cost processor try and pick that transaction, and it will go look at the default cost profile. You have flexibility to specify at the organization level or at the item category level. If it is defined at the item level, we go pick that cost profile or the cost method which is assigned to your item. Answer to that question is yes, you still have that flexibility. And how you have that flexibility, I will show you, because whenever we look at the cost into cost management, you always look at in context of cost organization and the cost book. I don't want to jump through the topics because it may be confusing a little bit for some of you guys. But whenever you look at the cost, you will look always in context of cost organization and the cost book, and you could have multiple cost book created, and then that will eventually help you to manage the multiple representations. And when I say multiple representation, you could have multiple cost methods as well. Same item could have multiple cost method, and but it is in context of different cost book altogether, and that would eventually help you to meet your requirement. In one BU, if I have multiple inventory organization, then do I need to create equal number of cost organization? And my recommendation is don't do it. Ideally, you would have one BU and you could have multiple inventory organizations within those BUs, and you could create one cost organization, associate all those inventory organization to that cost organization, so that you can use that cost organization to cost and account all the transactions which are coming from various inventory organization which are part of those BUs. And recommendation is that, or you could have one cost organization per inventory organization. You do that, and there are cons, and I'll talk about those cons. What are those cons if you have one-to-one mapping between your cost org and the inventory organization? Can we exclude an item from being costed when the item is part of another item? Example, engine or cost. Yes, you could do that. Don't even assign the cost profile, and those will not be picked up for costing purposes. Okay, so there are many questions. I assume that the costing method has to enable at the inventory organization. Can you please confirm? No. Costing method, it's something different. If you are from EBS background, you may have to unlearn those and relearn few things. Everything is on the cost profile, and you eventually go assign the cost profile either at the inventory organization level or inventory organization and the item category level, or it could be at the item level, and we'll talk about it. So it's not EBs that you go define at the inventory organization, and that's the costing method for all the item within that inventory. In inventory, you may have certain sets of items. As I mentioned, that you're buying some items and you're selling it. You could use actual. Some of the item you may be manufacturing it. In that case, your standard costing would be ideal for you. And some of the item you may want to average it out. As soon as you receive the purchase order, you would eventually have your average cost updated, and so on. So it's not at the inventory organization level. It could be at the inventory organization level, but it is not mandatory to do it at that level. So internal profits, Krishna, ask Srini tomorrow when you talk about SFO. So it depends, Prakash. Prakash has the question about sub-inventory have different cost, and will the movement of material between sub-inventory result in cost and cost variances? So it depends on what costing method you are using, and if it is average cost, it will eventually update the average cost of that particular sub-inventory, because the valuation structure is at the sub-inventory level. It will indeed do it, and then we would eventually account it, and there will not be any variance. If it is actual costing and the average costing, there will not be any variance. And if it is standard costed item, we go calculate the necessary variance, because purchase price could be different, but you are trying to account and cost it using standard cost, so there is a variance and we account it. But if it is if the item is actual costed or the average costed, there wouldn't be any variance. Can you show the profit at inventory? So profit at inventory would be part of SFO. Srini will talk about it tomorrow. Let me cover some of the other topics because I see their confusion boiling down from the costing method standpoint. So I'll cover some of the setups, and then probably you would be able to understand when I'm saying that there could be different costing method and there could be different valuation structure. When you have all of these different, that means it is a multiple representation, and we have your cost organization and cost book, and then you would eventually run the cost processor in context of those cost and cost book, and then it will go calculate it for you. Let me stop answering questions, and then probably I'll go over setups and talk about setups, and hopefully that will clarify all your doubts. So from the setup standpoint, we support actual costing. We support, when I say actual, it is FIFO, it's not LIFO. We support perpetual average. We support standard costing. And as I mentioned, that the cost method can be at the item level, or you can default it at the organization level or the item category level. And the reason is obvious. You could have different sets of item, and different sets of item would have different methods, costing methods. And when you define the cost method, you can define it using in context of set ID, meaning you define it once and you reuse whenever you have different cost organization. And then multiple representation we already talked about. We have got concept called rapid implementation. We'll talk about it in some time. So some of the key entities in costing, one of them is the cost organization. And as I already mentioned, that cost organization is the entity it holds all your inventory organization. And it holds all your inventory organization to cost and account your inventory transactions. It is a grouping of inventory organization for the purpose of administration and cost sharing. We have an entity called cost book. You use this cost book in context of cost organization. So whenever you want to look at the cost, it could be any item cost. You would always look it in context of cost organization and the cost book. It's an entity that acts as the container for cost accounting data. And it will also help you for multiple representation of cost data or cost accounting data. So let's say you have got, you want certain item to be costed differently. As you mentioned that if I have item and it could have various cost methods, which one takes precedence? It's not about precedence. It's about in which context you are running the cost processor. When you run the cost processor, you will run in context of cost organization and the cost book. And the cost organization and the cost book would eventually help you to manage what would be the cost method of that item. You got cost element. Cost element is the lowest level where you can track the cost. It forms the lowest level within the cost accounting application. You go store the cost, and cost will be stored at the cost element level. You could have material, you could have resources, you could have material overhead, you could have resource overhead, and profit in inventory. So these are the cost element type, and based on those cost element type, you can have your user defined cost elements. And you could have as many cost element as you want. But you'll have to take a trade-off decision, because if you have multiple cost elements, there will be multiple accounting entries like debits and credits. So if you are thinking that you want to have 5 cost elements within your cost accounting application, there will be 10 entries, 5 debits and 5 credits. Whenever you go account the transactions, you would have 10 entries, debits and credits. So most of the organizations, they would limit to 2 or 3 cost element and go track the cost. Cost component is again, it's the atomic cost which is coming from upstream application. So cost would come from purchasing, cost would come from payables, and the cost which is coming from upstream application, we call them as a cost component. But now everybody knows that we keep track of all our cost using the cost element. So we will have to convert this cost component into the cost element. Basically, we call it as a mapping. So we have a way where you can map your cost component to a cost element, and when we get that cost from upstream application, we automatically map it, and then we store that cost using the cost element, which is the atomic building block within the cost application. Next is the valuation structure. This is where you would specify your inventory attribute, inventory control attribute, I can say. So it is basically how you want to share the cost. You could share the cost across inventory organization. Like let's say you have 5 inventory organization and you have same cost. You have requirement to have same cost for the item. You could do that using the valuation structure. So valuation structure along with the cost method will eventually help you to manage the cost and account the cost. So this is where you would specify whether or not you want to share the cost across inventory organization, whether or not you want to share it by sub-inventories and so on. So you could go create the valuation structure and use that valuation structure along with the cost method. So cost profile, if anybody asks you what is the entity you would go look at in cost application or the cost management in cloud, it will be your cost profile. Cost profile is the entity which holds all your accounting policies. It could be your cost method, it could be your valuation structure, it could be your cost element, it could be your cost components and so on. So all of these will be in cost profile, and eventually you would assign your cost profile to either your item or you will default it on organization or the item categories and so on. So cost profile is the entity which we would use in order to get the cost method and other accounting policies assigned to your item, organizations and so on. Some of the prerequisites, we assume that you already have your enterprise structure set. And once you have your enterprise structure, we assume that you have already marked your business unit as the profit center business unit. So if you go to enterprise structure or manage business unit functions, there will be a checkbox. And I presume that you have already done it in foundation course. So that checkbox says profit in inventory. And once you make your business unit as profit in inventory, it's a profit center. It's not profit in inventory. That's the you have element type profit in inventory. I apologize for that. Profit center business unit. So that's the checkbox within the business unit configuration. Once you set that as a profit center business unit, you have flexibility to use that business unit into cost management application. And we assume that you already have inventory organization created and you have your set IDs created. If not, then CDAT would work for you. So once you have all of these configurations, you can go model your entities. And somebody had a question, can I have one-to-one cost organization and the inventory organizations? You could do that, or you could have all your inventory organizations within that business unit to stamped on single cost organization. So we have inbuilt validations where whenever you create the cost organization, you could classify your existing organization as the cost organization, or you can create your own. And you have flexibility to assign all the inventory organization within that business unit. So you could have all your inventory organizations of that business unit, and one cost organization would do the cost accounting and administration for all of this inventory organization. And I was talking about the cons. What if you have one-to-one mapping between your inventory organization and the cost organization? So what you'll have to do is you'll have to run the cost processor multiple times, because when you run the cost processor, you would run it in context of cost organization and the cost book. And then I'll again come back to talk cost book and talk about it. So try and make at least one or two cost organization, and then go from there. So there are a couple of ways you can implement your cost accounting. If you want to do POC kind of or CRP1 for your customer, you can use the quick setup. Quick setup is nothing but the rapid implementation kind of scenario where you go give you minimum information, create your mandatory setups automatically, and then you can start using your application. And another way is you can go create them manually. Let's look at the manual way of creating the configurations first, and then I'll show you the quick setup one. So first and foremost thing is from the cost accounting setup standpoint, we assume that all your inventory organization and ledger and legal entities are created. Another one is your cost organization and cost book. So this is the association which you would go create. Once it is done, you would have your cost profile. Within that cost profile, you have your valuation structure, analysis group, and cost component, and so on. So let's look at all of this one by one. So let me show you, because this is kind of important to understand. So let me go over application and show you some of the setups, and then come back and talk about theoretical concept. Uh, Go over setup and maintenance and in your implementation project. And I'll look at my implementation project. Go over manufacturing and supply chain materials management, and under that you should see cost accounting. You have your flex fields and so on. So let's talk about how you create the cost organization first. Go over this task called manage cost organization. You could create a new cost organization, or you can convert the existing organization into the cost organization. So this is one which I would be referring. So I'll do an edit of it. And once I edit, it's very simple to create the cost organization. Only setup here is the legal entity. You associate your legal entity to the cost organization, because legal entity is the umbrella terminology. Within the legal entity, you have ledgers and you have various business units, and within the business unit, you will have your inventory organizations. And as I mentioned, that the cost organization would act as a container for your inventory organization for administration and the costing purposes. So all the inventory organization within that business unit would be able to come and sit under the entity called cost organization. So this is how you would have that association. And you could have a cost book. So I'll go over cost book. That cost book also would be plain text. You would go create the cost book, and for example, I'll talk about a cost book called financials. So financial is the cost book, just cost book and description, nothing great. But the important setups would come here in the task called manage cost organization relationship. This is where you would be able to associate various inventory organization to your cost organization. So I look at the US operation, that's my cost organization. I would always use it for this entire workshop. So it would be a US operations, and you see here set assignment. It's nothing but the set ID. These are the set IDs my organization would use, and I would have various setup which are done in context of set IDs, and all of the setups will be applicable for US operations. So next tab is the inventory organization. This is where I would be able to assign all my inventory organizations. So Boise, the other day we have seen this is the contract manufacturing organization, but it is in context of US1 business unit. Dallas, Atlanta, Seattle, Chicago, and all these inventory organizations are within US1 business unit. All right, so all the inventory organizations are sitting under our cost organization, and this cost organization will account and cost all the transactions which are coming from this inventory organizations. So let's say Boise is the contract manufacturing organization. You go complete your work order. So there are inventory transactions, there are resource charges, so on. All this would come into cost applications, and then it will sit into interface table, and it will wait till the time you run the cost processor. And when you run the cost processor, you will run the cost processor in context of in context of cost organization and the cost book. Right? So how do we know which cost book to use? What are those cost books which are applicable? So you would go look at this cost book. When you come here, the setup of cost book was plain, like it says financials, you're good. But here, when you associate a cost book to the cost organization, you have a flexibility to specify whether it is a primary cost book. Primary cost book means you would have your costing, you would have your accounting, and then you would eventually transfer those costing and accounting and journal entries to GL. And this is the ledger you would go post to it. There could be ledgerless books. So you see US operations, you have Dallas, you have Boise, and SCM 01 cost book. They are ledgerless. They do not have any ledger. That means it is only for reporting purposes and internal to cost accounting applications. You could run the cost processor in context of US operation and US operation cost organization, and let's say Dallas as one of the cost book. It will go calculate the cost, and it will be there in the cost accounting application. It will not be transferred to GL because it's not ledger book. It is a ledgerless book. You could have secondary ledger, which will eventually transfer the accounting and costing to the secondary ledger. But here, if you see here, there is a currency, right? So you have got a financial as the cost book. It has got currency called USD. If you have a requirement to represent the same cost using different currencies, you could have different cost book altogether. You could create one more cost book and say currency as. Currency could be any other currency. And then when you run the cost processor, you will run the cost processor in context of US operations and any other cost or cost book, which will have different currencies. So when you assign the cost profile to item, you would assign it in context of cost organization and the cost book. So one item could be costed average. One item could be using, let's say, average costing method, and that would be in context of this cost book. Other item could be standard costed, which would be in context of this book. Another item, same item, which has different cost method in context of this book. So you can go do it, and I'll show you where you can go and do it in some time. So there is no precedence whatsoever. You can either default at the organization level and the item category level, or you can have it at the item level. All right, so we call it as default cost profile and item cost profile and so on. So this is where you would specify that these are my cost book. One could be primary, another could be secondary, and some of them could be ledgerless book. And you go run your cost processor using all of these, and then it will have multiple representation based on what you are running and where you are running. It could have another setup here, and that setup is called period end validation. So this period end validation is in context of your cost book. So you can look at it and say completed work order but not closed. What do you want to do? You want to error it out. So if there are any transactions, if there are any work order which are completed but not closed within that period, what do you want to do? You want to show is that error. All right. Likewise, you could have various other validations. You can go add it. I can try and create one cost book. I cannot create. I'll have to go pull it from there. Let me see if I can have any which are not used here. I'll try that, and I'll make that as ledgerless book. I can select the currency. I'll use the dummy data junk, just for your understanding. Right, and I'll use any other calendar, and it says that which one is your first open period. So keep this in mind. Keep your first open period which is closer to this date. Otherwise, what you'll have to do is you'll have to keep opening those periods till the time you open the current period. So you have here, let's say, first open period is March. You go open the March, and then you need to open February 2017 or January 2017 and so on. If you are first time implementing it, keep that first open period as nearer period so that you need to open multiple periods in order to open the current period. So you can specify how many maximum open periods you want. You can say I want 2 maximum open periods, and then go ahead and do it here, and then click on OK. And then when you say OK, you would eventually have these period end validations populated. All right. I'll probably delete it. I may not need it here. So this is what is cost book, and now you can have multiple cost book. You can have multiple inventory organization which is stacked to your cost organization. Any question here in terms of association? Can one cost org be assigned to multiple inventory organization? And yes, answer to this question is yes. So you have got cost organization and you can have multiple inventory organization. Okay. Where can I open and close the period? So there is a UI here under cost management. Under cost accounting, you could go open and close the period. Manage cost accounting period. Do we always need to assign default set to cost organization? Yes, reference data set is always needed because there are certain setups. For example, you have got cost element, you have got cost profile. They are always in context of reference data set, and if you don't assign it, you may not be able to pick those configurations for those cost organization. Is it possible to assign different cost organization at sub inventory of the same inventory organization? No, that's not possible yet. It is at the inventory organization level. But if you have different, I can say, whatever you are expecting, Anshul, can be achieved using the evaluation structure. Default means delayed, is it right? You can create your own reference data set, or you can use the seeded one, which is common and enterprise. As part of period close, when are the cost period close? Is it after inventory period? This seems to be new step in cloud. So Krishna, it's new, and we don't stop you guys, or we don't restrict you guys in context of closing the period or opening the period. You do your transaction independent of the cost period. And as a cost accountant or cost consultant, you could process the backdated transaction as well. Meaning, irrespective of when you are doing the transactions, you have flexibility to process the backdated transactions. So there are no dependency as such. And if you are not able to process those transactions this period, we go process into next period. So if you want to look at the dependencies, then there are no dependency whatsoever. You could do your inventory transactions, you could close your inventory transaction, and yeah. So basically, there are no dependencies whatsoever. You do transactions, and as a cost accountant, you figure it out in which period you want to process them. If the period end validations are controllable, yes. Example, pending transactions can be ignored, yes. It will have impact on accounting and costing. Can you walk us through the rationale behind it? So it will not have impact on costing and accounting. It just says that whether or not you want to close the period, or you don't want to close the period till the time you process them in this period. But even if you close the period, you have flexibility to account it into different period, next open period. So it's up to cost accountant whether to process those transactions within current period, or they can wait till the time the issues are fixed and then process into next period. It's such option whether or not you want to close the period. So the cost account period is for cost organization, which will control all inventory organization which are assigned to the cost organization. Answer to that question is yes. It will be in any entity, any information, if you want to look at it, it will always be in context of cost organization and the cost book. So keep this in mind, that cost book also is important, because you could have multiple representation, and you may be using multiple cost books. So you would have periods, even if it is ledgerless book, right? Ledgerless cost book, you would have periods associated to those as well. So it is always in context of cost organization and the cost book. And then cost organization will have various inventory organization. You can use the transactions which are coming from those inventory organization and do costing and accounting for those inventory transactions using the periods which are associated to cost book and the cost organization. Should we define one cost org per inventory org? I don't recommend, Ashish. Reason behind that is, let me go over that really quick and show you. So when you run the cost processor, it says create cost accounting distribution. Basically, it picks all your transaction and then do a distribution of it, and we'll have run control. And when you run this run control, it will be in context of cost organization and the cost book. So if you have one cost organization per inventory organization, let's say you have 10 inventory organization in your enterprise. So what you'll have to do is you'll have to run this run control 10 times to process the transactions. And my recommendation is have all the inventory organizations which are pertaining to a business unit clubbed under cost organizations called US operations or whatever cost organization you can think of. And when you run this cost processor, you would run it in context of cost organization and the cost book. And this cost book would specify whether it is ledgerless book or ledger book and what would be the currency. And then it will, for that matter, identify whether or not which cost method to use. So the recommendation is don't do that. And I don't think so anybody is doing it. When a backdated transaction is costed and the period is closed, then which cost is going to consider if it is going to the cost in next period, if it is considering the old average cost, and then there is a mismatch as the cost is not reflecting the current average cost. So when I say backdated transaction, you already have inventory transactions coming in, and you are trying to run the cost processor for that matter. And cost processor's cutoff date, one of the parameters is the cutoff date. Let's say the cutoff date is 31st October. If the cutoff date is 31st October and you still have a flexibility to cost and account the transactions which are for October period, but you have entered those transactions in November. So what you can do is you can go process them. So they will eventually be processed in October month. And I don't see an impact into average costing here. And there is tweet here. If you have advances the cutoff period, let's say you have made it at 31st November, and you have processed the transactions which are of November period, then the transactions which are meant for October period, you will have to process them in the November period. And I don't think so there will be any impact on the average cost. So you go take a Excel spreadsheet and then figure it out whether or not there is impact. There will not be any impact, because this average cost, it gets calculated at certain level, and that level is called valuation structure. So let's say valuation structure is at the inventory organization level, or for that matter, you can think of the sub-inventory. So what you do is we calculate the quantity, and then we look at the average cost. And let's say you have purchased something, and that item is the average costed item. It will go look at the valuation structure, and it will put that into inventory and then average out the cost. So doesn't matter in which period you are doing it. Does it mean that the period close is not mandatory? It's mandatory. You go close the period. But what I'm saying is it is independent of other periods. It is independent of the transactions which you are doing. We don't put you guys in a situation where there is no rollback. Meaning once you are closed, you will not be able to open the period, but you have flexibility to process those transactions into subsequent periods. So we should define one cost org per business unit. Yeah, that sounds promising. If I club multiple inventory organization to one costing organization, then the cost will be controlled at the BA level, right? No. The cost method, you would associate it in context of the cost organization, cost BU, cost book, and it could be at the item category level, or for that matter, it could be at the item level, and it could be at the inventory organization level. This clubbing of all the inventory organization, it is only for administration purposes and to calculate or to process those transactions. But when the cost processor picks those transactions, it will go look at what the cost profile associated to those items, nothing to do with your cost organization or the cost book. There are certain, I can say the configurations, maybe in what currency we should do calculate the cost, that will come from your cost book. But at the end of the day, it is the cost profile which is associated to your item. So Mati, your doubt will be cleared when I go over association of the cost profile to item. All right, let's get going. So we talked about cost organization and the cost book. Let's talk about the cost profile and how we assign this cost profile to your item, or how you default the cost profile. So I'll go over manage cost profile UI. Same implementation project. So here you go, manage cost profile. You go define the cost profile, and this is how your cost profile would look like. I can do edit of it, or I can create a one. So this cost profile will have various information which are associated to it. One of them is the cost method. All right. Another one is how you want to cost it, whether or not you want it in primary UM or the secondary UM. Valuation structure, I will talk about it, but it says that it is inventory organization. It is basically what will happen whenever you get the transactions. Those transaction quantity and cost will be maintained at the inventory organization level, and that's what it says, that valuation structure is the inventory organization. All right. So it could be inventory organization, sub inventory. It could be inventory organized, sub inventory, lot, serial, grade, whatever valuation structure you have. These are all your inventory attributes. Whenever I go over valuation structure, I will talk about it in greater detail. But this is where, along with the cost method, we will identify where to calculate the cost and store the cost. You have got certain setups which are in context of work order. Tomorrow, day after tomorrow, I will talk about all of this setup. Don't worry about it. And propagate cost adjustment. This is one of the checkbox here under the cost profile. If there are any retroactive changes, if there are any pricing changes, there are certain costs which have changed, and if you want to go propagate those changes all the way through the final transactions, it could be work order, it could be sales order for that matter, we go propagate it and we readjust it if you say propagate. So you have got valuation structure type, as I said, it could be expense as well. It says that asset, and you should have expenses, and you could have consigned. Consigned is for consigned inventory. You have a flexibility to deliver, the item which is into inventory, and these are all asset type of item. But you could have expense delivery, and that will go to expense side of your accounting, and then you have flexibility to keep track of the item quantity, and eventually it will go into expense side of it, or the P&L, on the P&L. And that's the reason we need expense valuation type, asset valuation type, and consigned. So you have got this cost profile, and as you know that cost profile will have cost method and the valuation structure and various other cost policies. So once it is done, you have flexibility to assign this cost profile. So you can go define the cost, assign the cost profile. You can say manage item cost profile. Go over manage item cost profile UI. You can go assign the cost profile in context of cost organization, cost book. So I can say financial is my cost book. I'll search it. So there could be n number of items, right? There are many items, right? So this item AAS 86006 in context of cost organization called US operation and cost book called financials. This is the cost profile, and within the cost profile, you will be able to see what's the costing method. You can say costing method is average cost, perpetual average. You could go add a line for the same item, but you can say in context of cost book called Beijing, it will be standard costed. Or for that matter, any other cost book. You can create your own cost book like DUR cost book and so on. You could have different cost method altogether for the same item. And then what we'll have to do is when you run the cost processor, you would run the cost processor in context of this cost organization and the cost book, and then you would get the another representation of the same item or the cost of the item. But you have thousands of items. Do I need to come in this UI and then manually add the cost profile? Answer to that question is no. You could do that if you want. If not, then go over something called default cost profile. Manage default cost profile. In manage default cost profile, you can, if you have let's say same I can say cost method for all your inventory organization, it is pretty straightforward. You say cost organization and a cost book. If this is the cost organization, if it is the cost book, don't give the category and then specify the asset cost profile and expense cost profile. Then what cost processor would do? Cost processor, as I mentioned, that it will pick the source transactions. It could be from various sources. DO is one of them. It will pick the source transaction. It will try and identify the attribute on those transactions, and then it will identify that the cost processor which we are running it in context of cost organization called US operations and the cost book called financials, and there are no other attributes. And it says that, hey, go ahead and pull this cost profile. It says that actual costed. Go ahead and add it. You could have certain sets of categories which could be actual costed, certain sets of category which could be standard costed, right? Here it says that smartphone is standard costed. So any item which has got a category called smartphone would be standard costed within this cost organization and the cost book. So you have flexibility to do it, and this is the defaulting one, right? So this is where you would specify how you want to assign your cost profile to your items. It could be based on the category, it could be based on cost organization and cost book, right? And you can say new item cost profile creation is automatic or manual, or it's not manual, it says review required. So when you say review is required, it means that system will go assign the cost profile to your item, but it will be listed in your dashboard that review is required. Go ahead and review it. For some sets of the item, you think that automatic is okay. For certain sets of item, you think that the cost profile, you need to validate it before you actually go ahead and cost and account it. You make that as review is required. You go edit it and say review is required. Right, so then just trying to do edit and then say review is required. All right, and other information is out here. So now, are you clear in context of what will take the precedence and so on? Because everything is in context of your cost organization and the cost book. And if you have any representation which is different, it will always be in context of cost organization and the cost book. And cost book could be different. And if you have cost book, you would have flexibility to have a different cost method and different currencies and so on. So it is not. It may not have a different cost method for that matter in context of same cost org and the same cost book. So whenever you need a different representation, you would have different, at least a cost book. All right, so let me finish some of these setup configurations, and then I will come back to the questions again. So next is, by now you would know that within the cost profile, you would have your valuation structure, you would have your analysis group, you would have your cost element and the cost component. Let's look at all of this one by one. So the atomic building block of your cost within the cost costing or cost accounting is the cost element, and then you would have your cost component which is coming from upstream applications. Analysis group is nothing but you want to slice and dice the data, cost data by various groups. You go look at it. So there are some of the setups which are set ID enabled. One of them is the manage cost element. You have got cost component, you have got valuation structure, and you have got cost profile. So all of these are set enabled. And once you have defined all of these, and creating the cost organization and various other setups is pretty easy. So the cost element, as I mentioned, that it is the atomic building block within the cost accounting application. You could have your user-defined cost element, and you can define it in context of the element type called material, resources, material overhead, resource overhead, and profit and inventory. And you go capture the cost, and whenever you distribute the cost, and under the distribute UI, you would be able to see the cost in context of the cost element. It could be material, it could be taxes, and so on. The cost which is coming from upstream application, we call it as a cost component. And since we manage the cost in cost accounting as a cost element, there is a mapping needed between cost component and cost element. So we do that cost mapping. There are certain overheads. Overhead could be from different sources. There could be overhead into manufacturing. So we go calculate overhead there and then bring those overheads here. But there are certain transactions, let's say purchase receipt, and you have got certain warehouse kind of or the facilities, service charges, and so on, which you want to accumulate and cost. You can create the overheads, and then to capture the overhead, you have cost element, where you can create a cost element and capture those overhead costs. There is an analysis group. It is user-defined analysis group where you would be able to specify whether the cost is direct cost, indirect cost, and various other costs you can club, and then you can use it for reporting purposes, just for reporting purposes. And this is how everything will tie together. You could have cost component. It could be PO price or item price. You can map this cost component to a cost element called direct material, which is mapped to a material kind of cost element. And then this cost element you can associate to an analysis group, and there could be multiple analysis group, and within the analysis group you have analysis code. And whenever you try and look at the cost, you go to review item cost, and then you have flexibility to review it. You can slice and dice the data by all of these components. You can look at the data, cost data by element, by analysis group, by cost component, and so on. So I will show you. I'll go to the application and show you how you can go look at it. So this is the UI where you go define your cost element. The UI is manage cost element. You define the cost element, and when you define it, it will be in context of set. All right, and when you define it, you can specify which analysis group. So you can specify the analysis group, analysis code. Whenever you see the cost, and in specific cost element, you have flexibility to slice and dice by the analysis code. So there is a UI called Manage Cost Component Mapping, and this is where you map your cost component to a cost element. So let's go into the application and see that. Manage Cost Component Mapping. And you could use this mapping. So you have got groups, component groups, and within that you have flexibility to map the cost component which are coming from upstream application, in this case item price or the PO price. You can map it to material, and whenever you get those PO and the material transactions or payable transactions, you'll be able to see them using the cost element is this. But when you move the transactions from one inventory to other inventory, or one organization to other organization, in ideal case, all your organization would be using the same sets, reference data sets, which you talked about. If they don't use the same reference data set, you'll have to map the source cost element to the destination cost element. So let's say you are trying to move the transactions or inventory from, let's say, organization 001 to 002, but they don't share the same reference data set. Then what you'll have to do is you'll have to map the source cost element to a destination cost element, so that whenever you move the transactions, you would have the cost in those cost elements, because cost accounting will always show the cost in context of cost element. So in ideal, it will be like to like, right? They use the same cost element, so it's all like to like. All right. So valuation structure is again, it's key concept. I think you should understand. Um, from the definition standpoint, valuation structure defines the level at which you want the cost accounting to track the quantities and cost of the item. And as I mentioned, that our design was, if you are able to keep track of your item at some level, we would be able to cost it at that level. Define a valuation structure for the possible levels that you will use for your item. It could be at the organization level. It could be organization and the item level. Maybe inventory organization you want to share. You define the valuation structure at that level, or you may have certain item which you control at the lot level. So certain items are lot controlled. So you can define a valuation structure, or you can define another valuation structure which could track the quantities and cost at the lot, right? And all this valuation structure would go sit into the entity called cost profile. And then you can use that cost profile for certain items. So you have certain sets of items which are lot controlled, assign the valuation structure called lot. So which means that each lot will have its own average cost, right? Same is the case with sub-inventory. You could have multiple sub-inventories, and those sub-inventory could have different cost. And this is where it is given in a diagrammatic format. So my valuation structure is sub-inventory. So I could have an inventory organization. Within inventory organization, I could have multiple sub-inventories. So I have got inventory organization called Miami, and I have sub-inventories called ABC. And whenever I got a transaction, cost processor will pick those transactions, and based on the cost policies which are assigned to the cost, which are specified on my cost profile for the certain items, I would go pick those items and then process them. And as I mentioned, that my cost valuation structure is at the sub-inventory level, meaning I'm tracking my quantities and cost at that level, right? Because when you get those transactions, you would specify in which sub-inventory you are getting it, right? All these are item attributes or transactional attribute. Our cost processor will pick those attributes, and it will specify, hey, this is for sub-inventory A. What is my average cost of sub-inventory, and how much quantity I am getting it, and at what rate I am getting it. And then what it does is it calculates the average cost of your item. It could be different for different sub-inventories, may be different, or it may be same. So it is at the receipt layer along with your valuation structure and the costing method which you use. So this is the significance of your valuation structure. And somebody had a question: if my cost profile or if my organization at the BU level, then I have a costing method at the BU level. That's something not correct. You'll have your costing method associated to your cost profile, and to the cost profile you would associate your valuation structure. So valuation structure along with the cost method, which is stamped on the cost profile, will identify where you want to keep track of quantity and calculate the cost. So you can specify attribute as inventory organization, or you could specify the cost organization. You could specify grade and lot and so on. So if I go over application, and then you would be able to see there are certain setups in context of valuation structure. One of them is the flex field. So flex field will identify what structure you want to use. We are not discussing flex field in greater detail, but let me quickly go over costing key flex field. And within the costing key flex field, one is for consigned inventory, another one is valuation unit. I'm trying to do edit of it. I'll go to manage structure instance, and within that I can go query it. And this is where you'd be able to see the structure, and it says that one of the structure is the cost organization and the inventory organization. Another says that inventory and the sub-inventory, and another one it says inventory, sub-inventory, and serial. And if you go edit it, you'll be able to see your cost organization and the inventory organization list of value associated to it, so that you can go pick it. And then it says that dynamic combination is allowed. So once you have your flex field created, you can go create the valuation structure, and that valuation structure would be based on your flex field. I can go over manage valuation structures. Within that valuation structure, you can specify your inventory attributes. It could be, in this case, it says that inventory organization. The cost organization is mandatory, meaning this first entity, and within that you will have your inventory organization. So this is your control attribute, that inventory control attribute, because using this valuation structure, you would identify at what level you want to store the quantities and cost. So it could be, as I said, sub-inventory. So you specify sub-inventory, right? And then you will be able to calculate the average cost by sub-inventory, average cost by serial, lot, and so on. So the valuation structure, as I mentioned, it will be stamped on your cost profile. So cost profile will have cost method and valuation structure, and these two entities will help you to manage your cost and quantities at certain level. Okay, so we talked about it. So cost profile we already talked about, so not going to go over. As I mentioned that you will have your cost method, you will specify in which currency, in which UM you want to cost, what is your valuation unit and valuation structure, and so on. So whenever you look at the cost, as I mentioned that you could have sub inventory, and sub inventory could have different average cost. Whenever you look at the cost, you would be able to look at it by cost organization, cost book, and the valuation structure or the unit. So valuation unit is nothing but the instantiation of the structure. So whenever cost profile picks this transaction, this your valuation structure is, let's say, inventory organization, it will stamp 001 because 001 is the inventory organization code. So you'll be able to look at the cost by let's say cost organization, US operations, and cost book financials, and 001 this is the cost, 002 that is the cost, and so on. You'll be able to do that. So this is the association of your cost profile. Cost profile will have your valuation structure. It will be like, cost organization, inventory organization, sub inventory, lot, grade, and serial. You'll have your cost element. These are the cost element type. You can create your own cost element and then keep track of it. But the trade-off decision, as I mentioned, that try and minimize your cost element so that you'll have less numbers of debits and credits. Otherwise, you may have multiple debits and credits whenever you go look at the distribution. You would have your cost methods and in which UOM you want to cost it, and various policies which are in context of cost. So all of these will be as part of cost profile, and then at the end, cost profile will be assigned to your cost organization, cost book, or inventory organization, or the item category, or at the item level. So this is how you would create a cost profile. We have seen that already. You can create it. You can have your review is required, or you want to automatically create it if it is a default. And as I mentioned, that default is something like this. So cost organization, I did not actually show you this UI, but you can create a new, or you can select the existing organization and classify that as the cost organization. And there are various roles which are generated out of box. And one of the important role in order to get your costing things going is the cost accountant. So cost accountant is the role which you go assign to yourself for certain business unit. And this is the cost organization relationship, which we have seen it already. So multiple representations we have already talked about, but this is how you would be able to specify the multiple representation. Using the cost book, you could have multiple currencies, but the method is different, right? You do not specify method at the cost book level, but when you associate your cost profile to the cost organization and the cost book, in context of cost organization and cost book, you can select another cost book which will have another currency or the cost profile. So you could represent the same product cost differently using different currency, different costing method altogether, and which you can achieve using the cost books. So you can have multiple cost book, and multiple cost books will have multiple currencies, and then you would have flexibility to assign multiple cost profiles. This is the cross book. We talked about it, and when you associate that, you will have flexibility. Then we have already seen from the association of your cost book standpoint, you can associate, and then there are validations. it will stop you from closing the period, or it will just give you error or warning, and then it will ask you to proceed further. From the expense pool standpoint, manage expense pool is where you can go create your expense pool, just a plain text. You can have your code name and description. Once the expense pools are created, you would go into the UI. And by the way, all this expense management is on the work areas, not on the FSM. So once the expense pools are created, you go configure your overhead rules. We could have absorbed some of the overhead based on certain transactions. It could be purchase receipt. It could be various other transactions. So you can go look at that overhead configuration. Could go over manage accounting overhead rules. And by the way, whenever you want to go look at the overhead, go into the UI. It is not available into the FSM. So I'll always go look at it in context of cost organization and the cost book. In this case, it will be financials. All right. So this is where these are the rules. It says name, and then you have your cost organization and cost book. And whenever you run the cost processor using this cost organization or cost book, it will go look at what type of transactions you are trying to process, and if there are any overhead routes assigned. It says that there is the overhead, and its cost basis is percentage value, and you go down below, specify the percentage of it, and whenever you do a processing of it, it will go calculate the overhead along with the material cost which is coming in. You can have various transactions here down below. You can go look at it. From the quick setup standpoint, again, it's one of the ways you can create your setups on the fly. And what you do is you would go over again FSM, setup and maintenance. And look at our supply chain offering. It's absolute. Yeah, so this is a manufacturing and supply chain materials management, and go over setups, and down below you would see cost accounting. Yeah, under cost accounting there is a gearing icon, bearing icon. You click on this icon, and it will take you to quick setup. So what we are asking you guys is just give the organization code and organization name and the cost method which you want to use, and we will do all of this automatically for you. And all of these are nothing but this one. What we do is we create the cost organization for you. We create the cost book. We map the cost organization to the cost book. We create the cost element. We map the cost element to the cost component, and we create the cost profile. We assign the cost profile, and we create the valuation structure and so on. So we do all of this automatically for you. Just give certain information like the cost organization code and name and method, and we create all of these setups. So we have already set up called enterprise, that's reference data set. We create the cost organization which is user defined. You can specify the organization name. We create the book called primary. We create the cost element, direct material, indirect material, and then direct equipment, direct labor, and manufacturing overhead. We create the cost component group. We create the cost profile, and this cost profile is depend on which cost method you specified at the time of quick setup. So if it is standard, you will create the standard costing asset and expense. If it is actual, we created this, and so on. And at the end, we create the valuation structure, which is at the inventory organization level. So based on this costing method and the inventory valuation structure, we would identify what is the costing method and what level we want to share the cost. So this is the quick setup. This is overhead, which we talked about. And there are certain schedule processes which we would run as we go along. I will show that to you when I go over UI. I'll go over UI in some time. So just keep this in mind. Some of this ESS job, transfer transactions from inventory to costing. It will pull all your shipping transactions, receiving transactions, and inventory transactions to the costing. You'll have receiving to costing, which will get your receipt transactions. You will have your payables to costing, which will get your payable invoices. Transfer transactions from production to costing. It will pull all your resource transactions from manufacturing. And import revenue lines is something which will import your revenue from receivables to the costing, so that we can have profit margin percentage calculated. So these are the ESS job which we would run into the costing, and along with that you will run the cost processor, which takes a little bit of time. And on Friday we'll have all of this ESS job running, and then you would see various accounting entries generated and so on. From the subledger standpoint, somebody had a question. Can we quickly go into the application and have a look at these account rules? I might skip the reporting and various other topic because of time constraint. Because report you can go look at it. Let me show you how you can go configure the SLA. I'll pick a very simple example of a sales order issue, and based on the sales order issue, I'll show you what are the accounting entries which should generate and how it is getting generated. So go over the same implementation project again, and down below you should see a subledger accounting rules. Click on the subledger accounting rule, go over subledger accounting methods, and within that method you have got general line rules. So if you are new to SLA and don't know how to configure, first and foremost thing is go to managerial line rule, which will specify what are your accounting line type, what are the events which you are trying to configure SLA for. So you would have various listed events. You can go look at those events, and you can go over event class called sales order issue. So let's say you got the material into your inventory and you are trying to ship the sales order, that is issuing the sales order. So when you go look at it, there are certain accounting line types. And by now you would know it will debit the deferred COGS and credit the inventory valuation. So you would go look at it. So debit cost of deferred cost of goods sold, and credit inventory valuation. So these are all your accounting line types, and I know it, and you would also know it. What are the accounting line types associated to various event classes? So one of the event classes is sales order issue. Another could be your PO delivery to inventory. So if it is delivery, it will eventually debit your inventory valuation, credit your receiving inspections, and so on. So you would know what accounting line type to configure for. So let's go back to sales order issue and see what are the accounting line types. So these are the accounting line type, and for this accounting line type you'll have to create a rule called account rule. So by now you would know we'll have to create a couple of account rule. One is deferred COGS and another one is let's say inventory valuation. So what you do is you go over manage account rules, and within the account rules you can go create your own account rules, or you can query the existing one. So I can say deferred cost of goods sold I should get. So I see it here, deferred cost of goods sold for US. I'll talk in context of US. You could pick any one of them. So it says that this is the constant value. You could write a source. You could use the source, and somebody had a question. We don't allow you to create custom sources, and how we can meet the custom requirement, and we analyze all common requirements, and then we expose them as the source. You can go look at the sources. There are thousands of sources which are listed, and then we still have a laundry list of sources which we can bring into the application. Go use them, and you could have constant and so on. So this is the account rule which will eventually give you this entry, the code combination. So whenever you have sales order issue, deferred COGS will be this account. Same is the case with inventory valuation. Go over inventory valuation here. I apologize if I'm a little bit fast, but I just wanted to give you the context. It's not part of our delivery. So let's go over inventory valuation and look at this rule, and this is how your inventory valuation would come, or you can use the sources. So once you have your account rule created, what you can do is you can go over general entry rule set, that is JRs, and that JRs would be in context of accounting method. And accounting method is one of the C which is associated to your ledger. So when you go to ledger, you create a ledger, and you have your FSM task called specify ledger options, where you have accounting method. So you have your JRS, and that JRS is in context of accounting method. So go look at the JRS. You could create multiple JERs and look at the JERs which is in context of your event class, and in this case it is sales order issue. Since it is sales order issue, I need the COGS recognition, right? And then this is what my JERs is. I'll go edit it. You can create your own. It will always be in context of event type and event class and event type. So when you are into JERs, you will be able to see cost of goods sold. By the way, all are debit, and we will identify based on the sign of amount. So deferred COGS will be debited, and inventory valuation will be credited, and system would know this is my deferred COGS account. So this is the account rule, which is the default account rule, which will go to your account rule, go pull the accounts for deferred COGS. It will go pull the account for inventory valuation. We will debit the deferred COGS and credit the inventory valuation. So this is how your system would know to calculate or to generate the journal entries. Okay, so when you configure your SLA, you go run the create accounting, you run it in context of cost management as one of the sub-layer application, and once you run it, you will be able to see these accounting entries. And in this case, it would be deferred COGS debit and inventory valuation credit. I'll show that to you when we go over application. So let me quickly go over application, and then probably we can take a question. So I'll go over costing, and within costing I'll go over cost accounting. So within the cost accounting, there is a landing page where you would be able to look at various status of your ESS job. So you have cost accounting processes, nothing but the cost process. When you run it, you will be able to see the status of it. When you run the period end validation report, or you go to manage period cost accounting periods, and let me look at the period for, let's say, US operations and cost book called financials. So I'll go over view period details, and I can go run the validation for, let's say, January, or is it January? Yes. So I'll say run validations. When I run the validations, so it will ask me for all of this I would like to run. Let's say okay. And if you can go back to overview page, you will be able to see the status of that run. So click on this button and you will be able to see. It was not current, by the way. So financials, and it was January. Oops. Okay, I should be able to see the ESS job running. Yeah, and then I can go wait and then get the details of this valuation report and figure it out if anything is going wrong and so on. So item cost profile, if you see, if you look at our setup, I mentioned that you can automatically assign the cost profile to the item. And there are certain items for which you may want review to be required, whether or not this profile is correct or not. So you'll be able to see it here, or you can go look at it from here. Review and approve the item cost profile UI. You can go look at it. You could see the work order cost using this UI called work order cost. Tomorrow we'll see all of this work order. Day after tomorrow we'll see this. You can go review the item cost. You can go review the item cost. From review item cost, you can, again, you would be able to look at the cost in context of cost organization and the cost book. Right, in this case, my financials. and I'll say honor. Okay, so here is my cost. This is my item. This is my valuation unit. Valuation unit. This is nothing but my cost organization called US operation, and this is my inventory organization. And it says that it's the actual costed. So what I'll have to do is I'll have to review the transaction cost. So when I go over review transaction cost, I'll be able to look at the cost. There are transactions which have happened on these dates. Right, so these are the actual cost, and it says that actual PO is received. So we have received PO, and this is my cost, actual cost of this layer. Basically, we store the cost at the receipt layer. So we have got receipt, and then you have got for this receipt, this is my unit cost, and then whenever I deplete it, I will deplete it from the receipt layer. And whenever you are to look at the cost, you will be able to look at it by cost element. So you see here this cost element, you can see it in a table or graph. You could see it by analysis group. If you have analysis group for this cost element, you could see it by analysis group. So it says that variable group or variable or so on. So let me see if there are any groups available. You will be able to see. So we have got this by groups. You can see it by the cost element type if you want. Right. You can see it by all cost element, and you can see it by analysis group. So you can slice and dice the data. Right, and you can go compare the cost. You can say I want to look at all my standard cost within this cost organization and cost book, and then I want a flexibility to go compare it. So you can pick and choose the items and compare the cost, and when you compare it, you will be able to compare in context of various other attributes like what I change now, and then you can basically try and compare the same item and then see why it is going up and down and so on. Let's compare. Okay, so you'll be able to do a compare, and you will be able to compare by elements. You'll be able to compare comparison by cost element comparison and so on. So you can slice and dice the data. You'll be able to see the information. Right. You could go review the cost distribution. When you review the cost distribution, you will be able to see it by the cost element. So review cost accounting distribution. Again, everything is in context of cost organization and the cost book. Okay, so I should pick the before because I may not have transactions this week. So I got the distribution. Rest assured, I will show you what distribution is and how we get those transactions accounted and costed. But if you look at it, certain transactions, you would be able to see that by cost element. Right, so you have got cost element here, material, it could be overhead, and then there is one more called property in inventory because it is getting transferred. It says that it is organization transfer, and you have booked certain profit within the inventory. So you'll be able to see it as a profit in inventory as one of the cost element. So it could come from various other applications, and then you will be able to map it to the cost element. So it says that cost component is the item cost, which is coming from purchase order. And that item cost will go sit as the cost element called material. So this is the mapping which we need between cost component and the cost element, and that's what we talked about. So you will be able to see the distribution here. Again, the distribution is created. This purchase order receipt, the receiving would do a distribution, and eventually you will have your journal entries created using the cost, using these create accounting ESS job. You have flexibility to look at the errors. You go review cost accounting processes. You'll have flexibility to go review it. You could go update the cost. You can go manage the cost, and you will be able to If you want to update the standard cost, you would have to go to cost and profit planning, but you have flexibility to update the average cost. You have flexibility to update the layer inventory cost and receipt cost. What you do is you just say create, and then you go search. You could search it by cost. Again, everything is in context by context of cost organization and the cost book. And yesterday we picked one item is 15,000. Go ahead and pick that. And search it. You could go pick the valuation unit in which organization you want to do the adjustment. It says 001. Go ahead and you have flexibility to adjust it. It says that whether or not you want the percentage changes or you can have new cost and so on. Click on next and then review and submit it, and you have your new cost available as of this date. So you can go update the cost. And standard cost, as I said, that you go to cost and profit planning and update it and publish it to the cost accounting. And various other UIs as we go along, we'll go over, look at it. So from the create cost accounting distribution standpoint, it is the run control. You go look at this run control. And then run it. There are various stages here. It says that preprocessor, it picks the transaction, and then based on the attribute, it will go identify the valuation unit, cost methods, and so on. And then cost processor will pick those transactions and then cost it based on the cost method. And at the end, when you have your sales order issues, and you have got revenues from receivables, you would go do a COGS recognition, and at the end you do the cost distributions. So you have flexibility to pick and choose what you want to run, and then or you can run all of these, and when you run, you will run in context of these parameters. And one of the parameters is the cutoff date. So currently the cutoff date is December 2017. You could process all the transactions till this point. Right, and if you got any transactions dated 1st January 2018, this cost processor will not process them till the time you advances this cutoff date. And as I mentioned that we are not dependent on which period inventory transactions you are trying to process in which period. So inventory transaction could be in any period. You can go process in this current period. We don't stop you guys from processing it. The previously created transaction is in the inventory. All right, that was from the demonstration standpoint as of now. Let me see if I missed anything. All right. We talked about the periods. From the period standpoint, we have already seen it already, so not going to go over again. And the reporting, from the reporting standpoint, there are seeded reports out of box. So you have got costing balance report, you have got gross profit margin, which you will see it in detail on Friday. You have got inventory valuation report, you have got WIP report. As a cost accountant, you may be interested in knowing what WIP balance as of date, and so on. So you can go run this report. You can run this revenue and COGS matching and so on. By the way, these are all seeded. We don't stop you guys from creating your own report, and for that we have got subject areas. You have got item cost subject area, you have got gross margin subject area, you have got cost transaction subject area. You can use this subject area, drag and drop columns, and then create your own report. And then you should be able to run those reports on the fly. And if you think that you cannot build your report using those subject area, go create your BIP reports where you can write your SQL and then create a data model and then use RTF template to pull the information for you. We can do all of this. So from the reporting standpoint, go run yourself and leverage the OTBI capability. From in the foundation class, I guess one of my colleagues might have already talked about OTBI and BIP, so you can go leverage this. I'll try and answer some of your questions and then we can call it as a day. Can this setup be overridden after quick setup? Yes, we can do that. If I have a cost method at sub-inventory level, cost method, it will be at the cost profile level, right? And then you assign that cost profile either at cost organization, cost book, or at the item category level. And along with the cost method, you would have your valuation structure, and then that valuation structure would identify whether or not you want to calculate the cost and keep the track of quantities at the sub inventory level or at lot level or a grade level. So Samir, what's your question now? If I have a cost method at sub-inventory level, where do I select the sub-inventory after defining the valuation structure? So after defining the valuation structure, your valuation structure would be, let's say, cost org, inventory org, and the sub-inventory. All right. So when the cost processor pick the transaction, right? When your cost processor pick the transaction, it will identify the cost profile. And on the cost profile, you would have your valuation structure. It says that valuation structure is at the sub-inventory level. So the cost profile will pick the cost transaction or the transaction and pull the information from the transaction, right? So let's say you might have put it into certain sub-inventory, so you would know what sub-inventory you put it. So the cost processor will pick all of those attributes and stamp those attributes on your costing or the cost transaction or the cost accounting. So whenever you go review the cost, you will be able to review the cost by cost organization, cost book, and the valuation unit. And in this case, valuation unit would be your sub inventory. Where is the accounting information configured in costing? It is through SLA, Krishna. I talked about one of the accounting called PO delivery and sales order issue. We don't store the accounts anywhere, any UIs, and then you pick it from there. Can we manage standard costing and actual costing for one inventory organization? And answer to that question is yes. Some of the item could be standard costed, some of the item could be actual costed, some of the item could be average costed. And what you do is you could have cost org and the cost book, and then using those cost org and cost book, you would have different costing method of the cost profile associated. So it's basically to do with how you are assigning your cost profile to your cost to your items, whether you are assigning it at the item category level or at the organization level and organization and cost book level and so on. When we don't have project manufacturing current release, how the cost management interact with project. So one is your miscellaneous issues to the project. Another one is you would have your service item purchased for a project, meaning you are trying to procure services for a project. It will be integrated through the receipt accounting. If the inventory organization goes to zero, then there is a cost estimated. No, if it is zero, there is no cost at that level. Whenever first transaction comes, we will figure it out if it is average cost, actual cost, and then we will have the same cost as of today. And then whenever next time it comes, it will go go find it whether it is average cost or actual cost, and then recalculate the average cost based on the quantities and then inventory cost. By the way, if it is average cost, you would put it into inventory whatever you got, and then system will calculate the average cost automatically for you. For cost adjustment, I assume the accounting entries will be generated automatically depend on positive. Yes, that's pretty much standard in SLA. So it's depend on positive and negative. It will identify the account. Where do you cost roll up? We do it into cost and profit planning. We will see that on Friday when I try and integrate our manufacturing and planning together. Because what we do is we pull the work definition from manufacturing, and then we do a roll up of your sub assemblies. And then you have flexibility to estimate the standard cost for purchased item and then push it into cost accounting for costing purposes. So we do all of this on Friday. So from the impact of the existing transaction, let's say if the cost is changing and you want to propagate those changes to all the way to the transactions, all the transactions, meaning the feeder transactions. In this case, some of the case it could be work order because you might have issued that item to a work order and you may want to go recalculate the cost of the work order. You can do that, and you may have already shipped the sales order and you want to go reinstate your COGS. You could do that, and that option is available in the cost profile. If you go edit the cost profile, propagate cost is one of the checkbox. You can go check that, and it will eventually, if there are any changes, it will go reinstate those costs. Is it necessary to define cost element to cost element mapping if the organization using the same set? Yes, you do as like same as same. Can you please elaborate one source destination cost element where it is going to be different? So, for example, you could have multiple organization and they use different cost elements, and the reason could be numerous. And I don't see a reason why they would have different cost element. But consider that they have different cost elements. And if they have different cost element, you are trying to move the item or inventory from one organization to other organization. And as you know by now that we keep the cost at the granular level called cost element. So we needed a mechanism to map it. So from this cost element, what would be the destination cost element? Because when we move this material from one organization to other organization, cost element may not be the same. Right, and if it is same, we are good. It is like to like, and if it is not, then you will have to go map it from the source organization to the destination organization. I have defined item, but that time I have not defined the default cost profile. Now I have defined it. Is there any way to sync now, or I need to manually assign it? No, you need not to manually assign it. You run the cost processor again, and then cost processor will identify for which cost organization and cost book you are trying to process. And then once your transaction is getting picked up, it will identify for this cost organization and the cost book. And then system will automatically pick the default cost profile from the UI and then stamp that cost profile to your item. You need not to do it manually. Okay, there is a question. Manufacturing, in manufacturing, there is no overhead cost element, and I was told it will be covered in the costing session. How to manage that? Is it stage tomorrow? So if you want to look at the manufacturing overhead, we will talk about it on Friday. But if there are any overhead which you are talking about in context of certain transactions, and one of the transactions, let's say purchase order receipt, you received certain goods into your inventory and there are certain overheads. Overhead could be your warehouse overhead, could be securities and so on. So you could figure it out. You can create your expense pool and then figure it out what kind of overhead you want to absorb if it is inventory transaction or a purchase receipts. You could do that in overhead. If it is manufacturing overhead, it will be discussed sometime on Friday. Because on the manufacturing, you have different sets of different ways to capture the overheads, and we'll talk about it on Friday. So it depends on where you are actually incurring the overhead. It could be at the time of purchases. It could be at the time of manufacturing. If it is manufacturing, we'll do it in manufacturing. If it is purchase, we will do it in here. Do it here under overhead. All right. There are a few questions which are not answered, and if you think that your question needs to be answered by me, please put them in the forum, and we'll try and respond sometime tomorrow or day after. I think we should break now, and then you have hands-on activities to perform. Let me see what are those hands-on activities. So you got lesson 3, 4, 8, 9, 10, and 11 today. Go perform it, and then tomorrow Srini will come back and talk about SFO, that is supply chain financial orchestration, and landed cost management. And Friday I will come back and talk about manufacturing costing and then various advanced fulfillment flows and how you can cost them. All right. Bye for now. I will talk to you guys on Friday. Tomorrow, all you guys and Srini. Thank you.